Welcome to Capital HQ, where exclusive access to the private market and curated deal flows await you. Dive into a world of possibilities, from innovative startups and scale-ups to lucrative IPOs and high-yield credit opportunities, all at your fingertips. Gain unparalleled investment insights from some of the leading minds in the industry. Stay ahead with our expert perspectives from around the globe. Connect and network with fellow investors of similar caliber. Join our exclusive in-person and online functions to share, learn, and grow together. And the best part? Joining Capital HQ is completely free for investors. Become part of our proprietary network of over 33,000 investors today. Discover, invest, and network with Capital HQ, your gateway to the future of investment.
Good afternoon, ladies and gentlemen, and welcome to the Capital HQ Online Investment Showcase. We are very excited to bring you today's event. So, the reason we started doing this is that we realize that often when we host our in-person events, many of you are either not in Sydney or unable to travel or may not just be able to come on that day to actually see the companies live and in person. So we actually built software inside Capital HQ to facilitate that journey. So every sort of 2 to 3 months, we look to host the Capital HQ Online Investment Showcase, where we can bring you some of the exciting companies that we have the opportunity to work with. Now, as I've mentioned in my previous sort of keynote speeches and talks, and I'll be giving you a talk later on today, really highlighting what my perspective is, and I suppose the context that I see what's happening in the markets and what I sort of think will take place over the next 12 to 24 months. Today is really about showcasing some exciting high growth and also high yield opportunities for you to have a look at. Now, the way this has been done is we've set it up in an easy way in which you can actually view the companies inside Capital HQ. I assume you're either watching this on YouTube or you're watching it inside Capital HQ. All you need to do to basically, if you like one of the presentations from the companies, simply request access to their deal room. And then from there, you'll be able to engage them directly. So they'll accept your request, and then they'll be able to have a conversation with you one-on-one. They have their information, their pitch deck, they have their sort of latest news, announcements, frequently asked questions, etc. It's all designed in a way to make it simplified and streamlined for you in accessing their information. So the other part about that's unique with today's event is that you get the opportunity to connect with other attendees as well. So if you go into inside the investor networking zone, you can see the other attendees for the event, and you can actually network with them directly. Now, we're also recording this, so if you're watching this after the event, we do recommend you still go in, request access, and then also communicate. Because to me, what's so important about hosting these online sessions is you get an insight into some of the exciting opportunities that we come across every day. Now, one of the things I'll highlight about what's different between the sort of online event as opposed to in person is that you're effectively creating the opportunity to engage at a much deeper level during the actual session. So whilst they're talking, not only listen to their presentations, but also use that second screen to go and do a deep dive into the company's opportunity or network directly with the CEO behind the company. So under the networking zone, you're able to see all the CEOs of the companies that are participating. You can message them directly there as well and have a conversation with them. So as part of today's event, not only do we have some exciting companies that are presenting, both on, as I mentioned, the high growth and also the high yield aspect, we've also got some great keynote presentations as well, covering different areas such as crypto, such as venture, etc., to give you a bit of an insight into some other perspective of what's happening in the markets at the moment. Now, I encourage you to stay to the end because that's when I'm going to be giving my talk. I'm going to be giving you a unique perspective across all the different aspects that we see, covering venture, covering private equity, covering private credit, and also covering digital assets as well. Now, just to be clear, we have seen a tremendous increase of enthusiasm in the markets over the last month. Literally within the last week, in the week following the US elections, we saw a $2 trillion of value created in the markets. And that's a really bullish signal for us as investors and also for us as business builders. So make sure you stay to the end of my presentation, you'll enjoy it. And on that note, enjoy the Capital HQ Online Investment Showcase.
Yes, well, thanks very much for having me, and it's great to be back presenting to the network again. If you're watching out there today, congratulations. Yes, I'm talking to you. If you're watching, it's likely that you're a sophisticated investor. You've worked hard through your career, you've accumulated wealth, and you have some capital to invest. Well done. I think that's worth acknowledging. Well, for people who have come across and clients of Deltine Capital who are in the same position, I often say there's two rules. Number one, don't lose it. And number two, make that money work hard for you. Now, these are not just throwaway lines because it's hard to maintain and retain wealth. Indeed, in 70% of instances, family wealth is lost after 2 generations. And actually, in 90% of instances, family wealth is lost after 3 generations. So these are things important that we need to remember when investing our capital. So how did this manifest itself into the actionable steps we can take when investing our money and choosing the right investments? Today, I'm going to dig a bit deeper into those two rules of capital preservation and income generation, and how that lays a platform for our investment philosophy at Deltine Capital in the funds that we've developed. So what does it mean exactly? Of course, it means having a diversified portfolio, having exposure across the different asset classes. And of course, it means for us personally, we're looking at least a 10% return for income generation. We believe that is working hard. That makes our money working hard for us. So we've looked at across the asset classes, and we've come up with a conclusion that, by the way, many wealthy family offices come up with the same conclusion in Australia, is that commercial property really does have that bricks and mortar downside protection, and it has the potential to have that high yield as well. Now, the high yield obviously has come down in the last years. Let's have a quick look at a slide to show the status of the market. Yes, and indeed we can see here when we're looking at this slide, over the last 40 years in prime CBD capital city commercial property, the yields have compressed from 10% down to 5 and 6%. But 10% still is available. We just need to dig in to sub-asset classes that fly under the radar of institutional investment, and we need to have a look further out from the capital cities into the regions to see quality commercial property does exist. So let's have another look at different spectrums of commercial property now and see where in the risk-return spectrum that we can play to get that capital preservation as well as the high yield. But of course, don't be fooled in thinking that all commercial property is low risk. Looking here at the risk-return spectrum, we can see that on the low end of the spectrum, you've got large commercial properties and senior debt in those commercial properties and yields of 5%. And moving up the spectrum, you've got stabilized income producing properties, large CBD properties. And then moving up the spectrum even further, you've got properties that have minimal refurbishment or tenant repositioning. So we're talking about starting to have a bit more of an active involvement in the asset. And then you're getting into the riskier end of the spectrum. You're looking at true turnaround situations and redevelopments and refurbishments. And then at the top end of the spectrum, it's pure development, pure mezzanine debt, sophisticated or complex capital structures, and being a developer in order to get that 25%. So we're looking for a combination of yield and a combination of capital preservation. And so we're looking at playing in the middle of this risk-return spectrum. So if we've determined that we want commercial property in our portfolio, then how do we get exposure to that? Obviously, there are a lot of commercial property funds out there, but as we've seen with the risk and return spectrum, they're not all alike. So here are 10 factors to consider when you're assessing commercial property funds for yourself. So let's just have a look at the different elements. So from an income perspective, obviously, that's one of the first things you look at, whether it's high income or low income, whether it's regular distributions or not. We also have a look at whether there's capital growth. Now, obviously, if it's an equity fund, yes, it's likely to be capital growth and therefore providing some inflation protection. If it's a debt fund, it's unlikely to have upside. From a diversification perspective, there's multi-asset funds and there's single asset, single project funds on the other side of the spectrum. From a debt perspective, we have low LVRs or high debt. Looking at the term, Now, this is an interesting one because I think terms that are too short, 6 to 18 months, well, then you've got to find another fund to reinvest your money, so you have a bit of reinvestment risk. Whereas 10 years is quite a long time. So I think looking at the midpoint there is a good way to go. And from a capital structure perspective, there are some that are very complex, which have second mortgages and mezzanine, convertible notes, or on the left-hand side, you can see there's also some simple vanilla buy and hold equity plus senior debt funds. Now, also, you look at the strategy. Is it a low buy and hold strategy, or is it a development turnaround complex strategy? Obviously, more risk on the right-hand side there. Governance, does it have an independent trustee and an AFSL license? From a segment perspective, is it a defensive sector, or like offices who had their problems in the last couple of years? The impact of working from home has had an impact on that sector. And of course, the team is another thing you look at, the experience and the execution track record of the team. So I think this provides you with a good overview and good factors to consider when you're comparing the commercial property funds. Let's pivot now and see how that investment philosophy has been the North Star for us when structuring our flagship fund, the Deltine High Yield Motel Fund. So the Motel Fund is a commercial property fund that will invest in a diverse portfolio of 50 high-quality, high-yielding regional suburban motels. So this sector is a highly fragmented sector, which is ripe for consolidation. There's a lot of properties in this sector that lack the scale required to make expense and revenue optimization. Now, such a consolidation strategy is quite a simple and proven strategy. As we all know, pubs, childcare, retirement villages, caravan parks in Australia have all been exploited before. But for some reason, the motel sector has flown under the radar a little bit from this roll-up strategy. And there is significant upside available. As we go through the presentation, we can point that out. So why motels? Well, they're quite a quality asset. When you're driving through into a regional country town, sure enough, in the middle of town, on the main road into the town, there's a motel. Now, these have great locations and they're fantastic assets. They're usually very good quality buildings, solid. They've got a track record of profitable operations and cash generation. They're actually available at purchase yields of greater than 10%, so that's really fantastic place to start when you're investing for yield. And there's various return upsides available, as I was pointing out before. These motels are generally essential service providers in the towns in which they serve. There's a lot of diverse economies in these local towns that rely on these accommodation providers to house corporate and business travellers and friends and relatives who are coming through the town. Priority number one for Deltine Capital is ensuring low risk. And what that means for us is capital preservation. And there's no coincidence that a lot of the positive features in a commercial property fund that we're looking at before can be found here in this fund. At the end of the day, this is where I've invested my money along with the other management members of the management team. And this is the type of fund that we want. So what have we got here from a capital preservation perspective? We've got quality property-backed assets. So when you've got property backing, you've got downside protection for your money. We have a low LVR, so a target debt level of 45%. We wanted to keep that conservative. There's diversification available, multi-asset diversification, and there's different towns and economies where you can get diversification across. We'll buy motels that have resilient operations. We've made sure we've instilled an independent trustee and have AFSL oversight. And also we've made a conscious decision to exclude high-risk properties. So no new build developments, obviously no single asset exposure, no turnarounds, and no pubs and gaming. And yes, we will have contingency planning with cash management as well. Now, what can bolster this as well is having good advisors. We've made sure we've got the great accountants, great legal providers, providing us with tax-efficient structuring, legal structuring. We've also, on top of these ones, we've gone to PwC for tax advice as well. So we're leaving no stone unturned to make this the best fund we can. Now, there is a bold claim here, 20% per annum is quite a bold claim. So let's dig into that a little bit. The investment strategy here is to acquire 50 motels Now, each will have adequate scale. So we're not talking the ones from 20 rooms or 25 rooms and lower. We're talking 30 rooms and higher. So between that sort of 6 or 7 million mark up to 20 million mark. And that sort of segment sort of is above your mums and dads, but below institutional investors. And it's a great segment to play in, we've found. So we'll buy those motels. There's always some low-hanging fruit with regards to revenue optimization. That might be dynamic pricing or yield management, or taking advantage of adjacent revenue streams. And of course, there's always a little bit of expense optimization that you can implement as well. And then on the exit, we can have a bit of an uplift after having gotten some of that economies of scale and some of that operational efficiency. We buy 10 to 12% and sell as a portfolio, a diversified portfolio at a lower yield, say 8 or 9%, thereby getting an uptick at the end as well. When you add all of that up, you're stepping into the investment with a yield of 10%. You get a little bit of margin accretion from the optimization and the economies of scale. Of course, there's great inflation protection for these assets because you can change the prices daily. You're not stuck into a long-term rental contract where rent increases are only reviewed every year. You can actually change the prices daily and therefore increase prices and therefore increase capital growth and get that inflation protection. And then, of course, at exit, by putting this portfolio together and getting a diverse portfolio, we can get that uplift as well. Now, it's quite exciting. We're raising money at the moment for this acquisition. It's a motel in the Barossa Valley. It's a 40-room motel. It's been renovated a couple of years ago, so it's in very good condition. And it's also in a bit of a hotspot for Australian tourism as well. And there is a bit of upside available in this instance. And we're picking this up between a 10 and 11% yield, so it's quite a good acquisition. So from a bit of an industry overview perspective, there's over 2,400 motels in Australia, and the sector has bounced back really strongly post-COVID. Obviously, there's been a lot of local travel, local tourism, and they're forecasting the market research houses are forecasting growth for this sector over the next 5 or 6 years. Now, that's underpinned by a shortage of new supply because the costs to build a new motel are quite high at the moment, but also the strong local demand as Aussies prefer local holidays, and then international arrivals are still growing post the COVID opening up. So that's 3 factors there that's driving those growth over the next 5 or 6 years. And there has been a history of room rate increases, which is underpinning that inflationary growth and capital growth. So referring to the team now, we've got a great team. Our motto is determination, focus, and execution. Now, as I was saying, this is a vanilla strategy, so it is all about execution. So we've assembled a team that is really good at executing. A notable member to point out amongst the team here is Craig Davidson, has 35 years of experience managing in the hospitality industry. Actually, after Hamilton Island needed to be turned around, he stepped in and turned it around and ran the place for 10 years. So he's got really good hands-on operating experience. He's sat on the board of Tourism Australia, Tourism Queensland, and has got other CEO and COO experience in experience and attraction companies. We've also got a great advisory board. So an advisory board, Howard, for example, is a guru in the hospitality industry, is a very notable and well-known advisor in this industry. And both Todd and Oliver have got roll-up experience in the senior living space in Australia, and Todd is an absolute guru in the commercial property sector. So we've got a great team around us. Last but not least is just having a good vanilla clean structure. We have the motel, the land and the buildings are ring fenced on one side, the operations in the other. That's really good for efficiency of ring fencing risk, tax efficiency, and also gives us multiple options upon exit, giving the investors a really clean and transparent structure there as well. In conclusion, we are open for investment. We have an active deal room on the Wholesale Investor Capital HQ platform. Thanks very much for listening, and enjoy the rest of the showcase.
Hello, my name is Leslie Chong, and I am the CEO and MD of Imugene. We are an ASX listed company with the ticker IMU. So here's my disclaimer. And just to be very clear, Imugene is a clinical stage cancer company. We're developing 3 drug products in CAR T cellular therapy as well as oncolytic viruses. Our investment highlights are quite full in that we have 4 unique platform technologies, all developed in the clinic with a long life patent portfolio. We're addressing not only blood cancers, but also solid tumors. And we have 4 ongoing clinical studies. And I'm proud to say that we have dosed more than 200 cancer patients. The 3 prioritized programs are allogeneic CAR T cellular therapy, and I'll go into that in just a second, as well as 2 iterations of an oncolytic virus. So our azer-cel, our CAR T for blood cancer, simply put, what is an autologous CAR T? And we have to establish that before we move into azer-cel, which is an allogeneic CAR T. So autologous CAR T therapy is a cancer treatment in which a patient's own T cells are reprogrammed in a lab so that they become something like a missile-guided product that goes after a certain protein on the blood cancer cells called CD19. So you see that is a patient's own T cells reprogrammed, and like a missile-guided drug, it goes only after CD19 that is represented in blood cancers currently. There are several autologous CAR Ts approved. There are no allogeneic CAR Ts approved, and we are one of the few companies that are developing allogeneic CAR T. And so allogeneic CAR T, rather than using patients' own T cells, we are using a super healthy donor T cells that are genetically engineered, and then the frozen batches are actually sent out to the sites, and they are on demand and ready as the patients need them. We're currently in a phase 1B, and we have just released really promising response rates of a complete responder. So we've dosed, more than that now, but 10 patients in the phase 1B study, where 6 patients were in cohort A, and then 4 patients in cohort B. Cohort B has a little bit of help from a product called IL-2, and this is a cytokine that helps your T cells live a bit longer. And what we saw was 3 complete response at the time of that data cut. These are patient population that have gone through several different lines of therapy, and also those autologous CAR Ts that I spoke about earlier, they had progressed off of those autologous CAR T, and our allogeneic CAR T is coming in there with healthy donor T cells and actually helping them fight off their blood cancer type, which is specifically in lymphoma in this case. This patient's scan says 1,000 words. This patient came in after failing off of 4 different lines of therapy to include autologous CAR T. The tumor was around the neck area, and even as early as day 28, you saw complete tumor clearance, and this patient remains in complete response. I'll move on to what's to anticipate, which is phase 1B still ongoing, and we will enroll upwards of 10 to 20 patients where we'll seek the FDA clearance for a phase 2 clinical trial. Now, oncolytic virus, simply put, our oncolytic virus is a virus that only replicates and infects cancer cells. So it replicates only in cancer cells. Cancer cells has a very simple design that's missing, and our oncolytic virus simply sees these cancer cells and replicates. And we know this as a fact because when we did a data cut of 40 patients, we saw one patient with complete response in bile tract cancer for more than 2 years now. We had 2 patients that had partial response, as well as 17 patients that were stabilizing their disease. So all these patients have failed off of 3, 4, 5, some 6, 7 lines of therapy prior to coming onto the study. So to have their very well-grown tumors to be stabilized and also see a partial response and as well as a complete responder, we're just delighted that we're seeing responses like this in this trial. We will continue to dose escalate and get to a recommended phase 2 dose. We currently have a bile tract cancer expansion and will move quickly as possible into a phase 2. So onCARlytics is the idea that our oncolytic viruses love to infect only cancer cells. And in this case, it shuttles up CD19. So we learned about CD19 protein earlier in that it's only in blood cancers, and there are several CD19 directed therapeutics that are approved. And so this is an idea to bring the response rates of 50 to 70% into solid tumors. So blood cancers have a wealth of arsenals against their blood cancers, and it's CD19. Solid tumors doesn't always enjoy that level of response because solid tumors tend to be quite mosaic and differentiated. So we have covered a solid tumor with CD19 flags or expression, and then add a CD19 drug. So onCARlytics, which expresses or covers a solid tumor with CD19, and then to combine it with a CD19 product. And in this case, it's a bispecific product that's approved by Amgen. On the right, you'll see a lot of drugs that are already approved in blood cancers that are CD19 directed. They give a wealth of response rates. Solid tumors, you can imagine, makes up 90% of the cancer type, doesn't enjoy a solid one target. And this is a means of providing one target with an effective therapy like a CD19 directed therapeutic. So it's currently in combination, and we are dose escalating, and we will continue to dose escalate until we find a recommended phase 2 dose and then move into a phase 2 dose. 2024 was a big hitter for response rates and clinical data, and we announced the azer-cel with 3 complete responses. We've announced on vaccinia study whereby a cancer patient has enjoyed a complete response for more than 2 years, and we've received not only fast track designation but also orphan drug designation by the FDA. onCARlytics entered into the clinic and is currently in combination, not only in intravenous setting with the combination of a product, a bispecific product called Blincyto, but also in intratumoral. This is where we anticipate some activity. So expected and upcoming key catalysts will be throughout with azer-cel in diffuse large B-cell lymphoma in phase 1b, onCARlytics with IT and IV combination doses, as well as vaccinia moving right into finding that recommended phase 2 dose and moving into a phase 2. My clinical team is well experienced. We have over 17 FDA-approved drugs that we have taken to market, and we want to continue that trend. So thank you for listening to my presentation.
Good afternoon, ladies and gents. I want to take you through Good Earth Dairy. But before taking you through Good Earth Dairy, I'd like to first highlight an opportunity in the market. So we've heard today about different disruptive technologies. This is a disruption to the actual commodity scale level in the infant formula sector. So one of the biggest misinformations globally about intolerance to dairy is I cannot tolerate dairy, I must be lactose intolerant. That's actually a false bit of information. It was not done intentionally. It's what we knew at the time. But the key reason for the intolerance to dairy is the allergen in the whey protein, which is called beta-lactoglobulin, and it is affecting at least 1 in 10 infants globally, which creates a lot of the infant formula opportunities around the world. Now, this is actually the biggest driver to the very large dairy alternative plant-based milk market, predominantly in the liquid form, which has, as you all know, made a huge traction and been a disruptor itself. The other main cause or opportunity, specifically in relation to infant formula, is that cow milk will hard coagulate in the gut. So it all looks beautiful in the bottle when you give it to the infant, but in the belly of the infant, it actually hard coagulates. Now, the current solutions to the cow dairy alternatives in the global market have really been both plant-based and goat milk-based, both with incredible growth trajectories and have achieved incredible growth in the last decade to 20 years. Now, in terms of infant formula specifically, plant-based does not contain the milk derivatives that are required for infant formula. The few things like soy and peas that have adequate protein, the protein actually mimics estrogen. And goat milk specifically still contains that key allergen, and it still hard coagulates in the gut. But it is, from molecular structure, slightly better than cow milk, which is why it's essentially taken the top shelf market in many countries as infant formula. Now, this brings us to camel milk. Yes, it's been drunk for thousands of years in the Middle East and northern China. However, the benefits and the understanding of the milk are not well known. It is the only animal milk without this particular allergen that lives in the whey protein. It is the only animal milk that will not hard coagulate in the gut. There's a lot more to the chemistry superiority of camel milk. Just a couple more examples is the whey to casein ratio, the molecular structure of the fat cells, the chain length of the fat cells, all making it more digestible. And we believe it will eventually make way completely with both cow and goat milk as infant formula, but you can't print it like an iPhone. It'll take a very long time to see that actually happen. Now, just another little bit of a fun fact about the camels. There are much better processing units, if you think of it as a process, in extracting nutrition from food to milk. As a result, naturally higher in things like iodine for infant development, brain development, as well as the copper and zinc for immune system, which most of the world is quite aware of at the moment post-COVID. Huge market opportunity. 1.4 trillion is the dairy complete. Over 78 billion is the infant formula space, with a camel milk current market of only 3.5 billion, and very little of that actually makes it into the infant formula space. So huge opportunity to penetrate the existing market. And as you can see, there's trajectory and growth as well. So it's both a growing market and a penetration opportunity. Now, the Chinese market is a low-hanging fruit. We do intend to take this globally. However, the segmentation of powdered products in China is incredible. And the market awareness of the benefits of camel milk, it might surprise some of you, but it's actually the Chinese who are most intelligent around the benefits of the milk because of the camels in northern China and the Chinese medicine based a lot on food-based. They've actually got an appreciation and hence a price position that's a very strong low-hanging fruit, especially for Australian companies moving infant formula into China. Now, just wanted to highlight an example. I don't know how many people here have heard of the A2 because we have some visitors from overseas. A2 has had tremendous success in China already with $612 million sales. Now, they claim to have a slight point of difference in cow milk, some incredible marketing that they've done. And I guess the opportunity we have here is well and truly to disrupt that with a significant point of difference to anything that exists in the market. Now, who is Good Earth Dairy? We're not purely a pioneer camel producer. We're based on mining first principles. I'm ex-BHP, 14 years chemical engineer. We've developed a lot of technology in both nickel and alumina. We've spent 9 years and $9 million developing different processes and custom-built designs and inventions to be able to be a cost leader in what we see as a future commodity. We wish to be the BHP of the camel milk powder, not only to have our own infant formula, but also to be the powder commodity producer for the other infant formula companies globally who wish to produce camel milk infant formula once the market awareness is brought forward. We're situated on 2,000 acres, just an hour and a half north of Perth. We have a dairy with our genetically superior herd, as we've been breeding for the last 9 years. The average camel is 5 litres a day. We've got our 12 litre a day camels, with some doing much more. We've got a small manufacturing facility where we've done a lot of products. I was amazed to be the first camel cheese in Saudi Arabia just this year. And that's because it does not coagulate readily. There is a bit of a process to it, which is why it's such a good product for infant formula. So we've developed some fresh produce purely as we scale up, but ultimately our goal is the infant formula space. Just a few more strategic advantages that exists in Australia and also predominantly in Western Australia. A lot of people are not aware, even I wasn't when I was in Australia for over 20 years. We actually have about 1 million camels in Australia. They're ferals. We're very fortunate that a lot of the diseases and parasites that plague the Middle East and West Asia did not make it to Australia when they brought the camels here to get into the goldfields in Kalgoorlie. As a result, there's a huge abundant livestock that's healthy. Again, our technology, part of it is to, well and truly with practically no human labor, convert those ferals to domesticated animals. We have the best climate in Western Australia, and from a cheap land and abundant hay, we're well and truly positioned for success where we are. The first growth phase to commercialize our technology, we're looking to build an infant formula facility in Western Australia, which will be the first. This has been backed by the West Australian government to the tune of $4.4 million, a highly competitive grant process. And we're being led by CPS Capital for a $10.5 million IPO next year. And this is to scale the existing dairy, and the infant formula facility will be able to produce the powder for 1.6 million tins per annum as a first phase. And we see our minimum wholesale price initially being at $45 a tin. What we're looking for is actually, there's been a lot of great presentations today and projects, but I don't think anyone has been as humble as us. The pre-IPO capital we're chasing is $600,000. It essentially buys a major part of the business. It's to fund all the documentations, prospectus, investigative accounts report in order to take us to IPO. And we're also looking for people who are interested in the IPO at the same time to take this forward. Thank you all for your attention, and I'll be outside if anyone's got any interest. Cheers.
Welcome everyone, my name is Ken Savage. I'm the Managing Director of Performance Processing, and we're here to change the way lithium is produced. Just quickly, there is a disclaimer here because the numbers I'm about to quote to you are based on our concept study modelling. We're moving into pilot phasing, etc. going forward, so just please bear that in mind. So why are we trying to change the lithium processing industry, and how are we going to do it? Well, the first thing is there's two parts to what we're going to do. We're taking gas heating in the process out and replacing it with microwaves, and we're going to introduce a simpler lithium product to market for producers. The reason we're doing that is twofold. The first one is that the EU is driving, as you can see, the green lithium market to say that they want a reduction in emissions by 2030. And the other reason is, did you know that like 50% of lithium is wasted in the standard processing as it happens now? So the problem is, as I say, over 50% of lithium's lost as it currently stands in the process. It's high cost, high carbon emissions, and the falling prices are putting pressure on producers. There's also a limitation as to the current processing as to what their product is in terms of constraints for who they can sell to and the pricing. So by introducing microwave into the process, we see major benefits across the board. As you can see, there's some big numbers here that our modelling shows are realistic. Once we get through piloting, there's a 40% increase in the lithium recovery. There's substantial decreases in capital and, more importantly, operating costs when it comes to the plants that we've developed, which are modular plants that you can put on mining sites. There's an improvement in the energy efficiency by 80%, which leads to the 80% reduction in the CO2 emissions. And that is meeting the drive by Europe in particular to get emissions down. And the other thing is, by our process with our modular plants, is we're introducing a new product with lithium sulfate into the market. And by doing that, it gives the mine sites, the mining producers of lithium, control of the value supply chain from 30% to 70%. And what that means is it is bringing small and medium operators onto the market where they're needed. So the market opportunity is huge in lithium. There's a lot of talk around it now, but the United Nations figuring still says, still holding strong, that lithium demand projected to increase by over 1,500% between now and 2050. More importantly, for our particular target market, those same United Nations numbers are saying to meet the 2030 criteria for net zero, there's another 70 mines that need to come online between now and 2030. So why do we have a competitive advantage now bringing this to market? Well, the first thing is that we have patent pending technology. The international patent applications that we've put forward have recently been passed by the International Preliminary Examination Review, and they've ticked us off for both innovative and novel. So that's a big plus. Whilst it doesn't guarantee the individual country applications, it's certainly 75% of the way. It gives us high level of confidence. The other thing is our strategic partners. Now, we are bringing together a formidable group in this space. The first being AMT, Advanced Microwaves Technology. They are a company out of New South Wales in Australia that was born 35 years ago from the Wollongong University through research and development. And they've got 35 years plus experience in microwaving at industrial scale. The second of our strategic partners is a South African company called DryTech International, and they have over 30 years experience in thermal drying technology. So our exec team, as you can see, there's plenty of grey hair and no hair in this group. We've all got over 40 years experience in the industry. More importantly, to focus on is the fact that we have 24 years combined experience specific to lithium processing. And that covers from design and constructing major plants to, more importantly, the operational side of things, both in Australia and China. We're now working to a specific 5-year development plan. We have self-funded to this point. We've taken our technology as far as we can take it in terms of proofing it in a batch phase. Now we're moving into where the rubber hits the road. That 5-year program is on the basis of the next 2 years, where we will go through a pilot, specific targeted milestone-based pilot program. When we tick each one of those boxes as we go through, we then move into the feed, front-end engineering and design, specific to setting us up so that the target within the 5 years is that by the end of 5 years, we have developed and sold to market 3 5-tonne per hour microwave-based modular plants. Each one of those plants is targeted to have a gross operating margin of $25 million US per plant per year. That's where we believe this technology is taking us to. As I say, it's a clear indication of where we're going and what we want to achieve. The first 2 years, we don't make money. We start making money once we've specifically start selling the units. At the moment, we're currently working with 2 of Australia's larger lithium mining producers, both of them publicly listed, Core Lithium and Mineral Resources. Both of them have engaged us to look at their process flows. In the case of Mineral Resources, we've been awarded a $500,000 concept study services contract to help them address the fact that they've got quality problems with their feedstock. As we say, our technology is going to reduce emissions in a big way. Our technology, these are real numbers in comparison for producers, and they're based on EPA applications made in Australia by producers. So our investment opportunity, we're looking to raise $6.5 million, and we're looking to do it in staged raises as we can step through a two-stage process. As I say, stage one, pilot plant, stage two, feed. The reason we're pushing this and our valuation of the company is high is that we believe at the moment, given the significance of the progress of our patents, the company's valued at approximately $30 million US with the patents and with our current results as we've done with our testing. More importantly, we value the company once we get through feed at US $80 million. So we believe there's plenty of uplift for investors at this point in time. The reason we're using those numbers is we've checked the market for comparative technologies, and the only one that we can find that's close to comparing with us is Canadian-based technology in the lithium brine sector of the market. And lithium brine only covers 30% of the market, wherein lithium hard rock covers 70% of the lithium market. Just keeping an eye on the time, just to quickly let you know, we've been going since November 21. As I say, we've self-funded to this point. We've stepped through an iterative process of testing, and most importantly, we've pushed hard and managed to get success with the process for international patent pending. And so now we're on our journey to individually seek patents from the companies, from individual countries that are in this space. Our next steps, as I say, we're looking for investment now to move forward. We have a clear plan for a 5-year development, and we genuinely have the belief that this is transformative, this will change the industry, and it's a great time to be involved now. So thank you for giving me this opportunity to talk to you.
Hi, my name is David Hayes. I'm the founder of Babeltext. Babeltext is going to reinvent your customer service. So the basic principle about Babeltext is all about taking your customer service from voice to messaging. We do messaging like your customers do. Think about that for a second. You can chat with your customers through their preferred messaging app rather than being confused on a voice call, which is highly inefficient. So if you engage your customers on messaging, you're also, through Babeltext, engaging your customers in their language on their device. How does Babeltext work? It's really simple. A consumer can message in Mandarin. That message will come into the platform. It'll be automatically presented to a live operator in English. That live operator will then respond in English, and that response will automatically then go back to that consumer's messaging in Mandarin. And we do that for 135 languages. So today, customers want to be able to message rather than speak on calls. So we empower your business from all sectors to engage globally with their communities in 135 languages using their customers' preferred communication and social channels. That's a really important thing to understand, because messaging is not just SMS. It's web chat, it's Facebook Messenger, it's WhatsApp, it's WeChat. All of those messaging platforms are integrated with Babeltext. So the basic stat is 64% of customers preferred text for their customer service. So let me give you some basic facts. Voice is $1.50 per minute, and it forces real-time participation. Significant time is invested not only with the live operator, the customer service agent, but also the consumer. And the first contact resolution is about 76%. And there's also that potential for miscommunication, and it's mostly English. Whereas with text, it's around about 9 cents to 15 cents per minute. The consumer responds when it's convenient to them. There's no time pressure. First contact resolution is about 80%. And you have that conversation history in all of the languages, and of course in 135 languages. So why Babeltext? Very simple. It's unparalleled engagement. It communicates in 135 languages. You can integrate Babeltext into your existing ecosystem. It's simple and intuitive for the customer service agent. You foolproof your customer service by understanding what they really want by having that entire history of that conversation. And of course, we customize and white label for you. So, as I said before, how does it work? Messaging is not only SMS, it's WhatsApp, Google Business Messenger, Facebook Messenger, web chat, Discord, SMS, Telegram, WeChat. So with Babeltext, you can have a situation where a consumer can start their conversation on SMS, and then they can go to Facebook Messenger, or they may want to go to Discord, but it'll all be presented within the customer service agent's web interface in one conversation history. So one conversation history within the operator interface, regardless of what channel they use. So Babeltext is efficient, cost-effective, multilingual, and secure. We are an AWS partner, we're an AWS qualified software partner, and we're an AWS public sector partner. So this is the fundamental architecture of Babeltext, with the various channels, the conversation channels being WeChat, web chat, SMS, Facebook Messenger. By the way, we are the only multilingual web chat in the marketplace. So again, the consumer text in their language, it goes through XConnect to validate their mobile number. It goes through the messaging pillar, the translation pillar, and the dashboard, and then presented in English to the customer service agent. The customer service agent then responds, and that customer service agent in English will be automatically translated back into the language of the consumer. So what we're doing is we're providing you the opportunity to engage in your customers in their language and on their device. Now, Babeltext has also got tabled for Q4 this year to be able to provide the platform not only in English for the operator, but Vietnamese, Punjabi, and in Filipino, to provide the opportunity to use the platform with operators from various parts of the world. So where's the product fit for Babeltext? Healthcare, of course, dealing with cultural and language diverse patients. Government, when they have maybe a council where a high non-English constituents. Hospitality, well, that's obvious. You have non-English speaking guests. Corporate, globalize your customer service. Help services. Mystery Shopping told us that there's no help service in Australia that supports a cultural language diverse community. Education providers, student communication, overseas students, immigration, that's of course. And of course, crypto, that is a massive market using Discord and Telegram platforms. So how do you take your voice customer service and migrate it to messaging? It's very simple. Use devices such as the QR codes. So you fundamentally have QR codes on your website or on your marketing material. The consumers just simply scan the language of their choice. It'll open up the SMS on their mobile phone. It'll pre-populate it with a number and pre-populate it with a message in language. They then just scan, click, and send, and they're automatically communicating in their language with your customer service operator. So the key statistics, it's a preference for customers, texting, customer satisfaction. Well, we all know about customer satisfaction scores. Cost saving is considerable cost saving for both business, and the most important is efficient for the operators. And there's a massive demand in messaging with messaging apps across the globe. So our solution is very simple. It's one interface, it's scalable, it's a SaaS platform. There's cost savings with customer service agents being able to manage multiple conversations, and customer presentations are never lost. You can target the audience because messaging is ubiquitous. And demand, well, SMS, web chat, WhatsApp, Telegram, they're all able to be used in 135 languages. Now, when it comes to translation, the Babeltext platform had a positive independent review carried out by the Ethnic Community Council of New South Wales, where they endorsed Babeltext to say if you wanted to engage with the cultural and language diverse community, Babeltext is the platform to use. So when you migrate to messaging, what do you have to do is you have to advise your customers. So we have a message broadcast platform as well. So you can load your customer database in, broadcast a message out to your customers. They'll respond. You have that live operator conversation. There is a positive outcome. You can then retarget them and create that conversational marketing opportunity. Teams, well, talking with teams, let me give you a typical example. We've got 15 builders out there in the marketplace who are running around doing odd jobs. How do they communicate with a central location? How do you keep a complete history of all those conversations and they have a central source of truth? Babeltext is a perfect application for your team. So we have two platforms, which is one is the multilingual customer service platform, one is MessagePort. One provides that conversation in 135 languages. It's scalable, it's omni-channel. You can export all the data, you can integrate with your existing CRMs. The MessagePort is our broadcast platform, which enables you to broadcast message to all of your customers. You can have personalized message, mass sends, alerts, multilingual broadcast, and you can also integrate with Microsoft 365 and many other applications. Sentiment analysis, this is the big opportunity moving forward. When you have a conversation history, you are able to analyze that conversation history and you're able to understand the sentiment of that consumer. This is the great opportunity that AI provides to Babeltext. And we are working with AWS to build a AI generative sentiment analysis platform that'll be integrated within our dashboard. So you as a manager will be able to analyze that conversation and pick up the true sentiment and trends on all of the conversations that are generated within your conversational marketing. Babeltext and AI, this is the new buzzword, but more importantly for Babeltext, it's all about analyzing the conversations, not creating the conversations. We're not an AI bot. We use live operators, and of course those live operators generate conversation. But when you're able to analyze that conversation and analyze the language, know the mobile number, analyze the social media conversations, and with the large language models, we are able to get really to the core of that conversation and restore a measure of surprise and delight in that customer experience. Predict and prevent. Relevance means revenue. Our team is a good, solid team with myself. We've got some strategists. We've got a good tech lead, good tech team. We've got a couple of marketing people. Our CEO has been there since day one. We've got a good UI UX team. We've got a strategist over in France to help us with global penetration. We've got some good legal and accounting partners, and with our R&D is all managed by Deloitte. So that is Babeltext. We hope that you have enjoyed the presentation. Please, if you have any questions on the platform, please don't hesitate to reach out. And let me finish by saying your customer's message to you, future-proof your customer service. Thank you for your time.
Hi, everyone. I'm Adam Good. I'm the founder and CEO of Auric Essentials, a company poised to revolutionize how you think about wellness technology. So in today's hyper-connected world, balancing life and balancing your life in this environment is extremely difficult. Those various different mood states you need to jump between being focused, being energized, having a good night's sleep. Even the most health-conscious individual struggles with this constant ability to do this. Now, we've got visual aids like Netflix to help us relax, or music to do the same thing, but one of our most primal senses is very, very much under-indexed, and that's the power of smell. Now, aromas, especially those from nature, can profoundly impact our well-being. We know that the ability to regulate our moods, they solicit memories, and they provide emotional responses. And this is what we're doing at Auric. We're building and introducing the Auric Aromasphere. It is a beautifully designed, highly personalised IoT platform that blends the evocative power of scent with cutting-edge data-driven technology. I want you to imagine the elegance of ESO, the functionality of a product like Sonus, and the simplicity of Nespresso all brought together in one device. Now, what the Aromasphere does, it's equipped with 8 TGA-approved essential oils, and they're uniquely created to blend these rituals together. Now, the rituals are from scientific research to help with sleep, with energy, to help with anxiety, and they support these distinct mood states that we require, such as sleep, focus, relaxation. And the Aromasphere really gets rid of those key friction points with the aromatherapy industry. They're messy to blend. You're not quite sure what oils to use at what particular times, and it's certainly very low-tech and not connected. And this is what sets us apart. We've got this Auric Wellness Signature. It's an algorithm that adapts in real time. It takes data sources from your calendar, from weather conditions, also biometrics such as Apple Health, Google Health, and combines that with the combination of your health questionnaires to actually deliver these bespoke rituals delivered at points in time. So if you'd think of Auric, it is really a mood as a service. If you and it can be the centerpiece of your daily habits. It's for the bedroom or the home office or the living room. So imagine at night time you're preparing for bed or thinking about it. The Auric Aromasphere will deliver a sleep ritual at that point in time. It's connected to other IoT devices in the home, so the lights dim, music can play. You might get a dash of lavender, peppermint, and bergamot. And through this sort of Pavlov's dog sort of theory, you will actually be triggered to get ready for sleep. So the growth drivers in this area is really the wellness industry. It's growing at a very large clip. It's about $4 trillion industry. We've got wearables now at over a billion users of wearables. And this convergence of your home IT, IoT technology in the home is also growing. But really, scent as a product category hasn't really been tapped into at the moment. So this idea of connected aromas for their therapeutic mood enhancement is an area of growth. What we're tapping into is sort of the convergence of 3 markets: the $1 trillion IoT market, the aromatherapy industry is growing at $13 billion, and then they've got the wearable wellness tech industry. And we see a TAM of $1 billion, and we're focused in on a 5-year plan of a sum of $100 million. It's a hardware recurring business model. So the device is at $299, which comes with the 8 therapeutic oils. And then from there, you go on to repeat purchases, which are high margin business of essential oils. You can buy one oil at a time, like you might do with a Scent Candle subscription, or we're moving people towards more of the subscription-based model. The founders, myself, I built a hardware recurring business model at Telstra some 12 years ago when streaming television was at its infancy. So we know about finding the right audience and the right product market fit. Alex is a robotics engineer, and we've also got a pretty incredible product team, including Eric Aldrin's part of the Meta team that's been doing the HoloLens work. as well as biometric experts, and Robbie Wells, an industrial designer from Breville. So competitive state, we're really the aromatherapy industry and the essential oils with companies like Deltine, Young Living. You've got your wearable sort of partnerships as well. We're more into this highly personalised, multi-sensory experience, working with the Google ecosystems and the Apple ecosystems, Philips Lighting, those type of products. Traction-wise, we've already had 45,000 in sales. We've got about 1,500 people in a wait list. We've recently been funded by Antler. We've been in this residency program downstairs, building this product out. Our manufacturing, our trademarks are all secured. And we've also secured a major media partnership with The Block. The Block next year, we love that show, 1.8 million, 2 million users. They're doing a wellness season next year in Dalesford, Victoria. So 2 of the contestants will be wired up with the Aromasphere. That's a very large audience. It's 1.8, 2.6 million people. That'll really show what this product is all about, working alongside sort of new technology. We are the Australian Startup of the Year. Next week, we're off to represent Australia at the Entrepreneur World Cup in the Middle East and Saudi Arabia with our product. So thank you very much for the time. What the ask really is, we're halfway there of our $500,000 seed round. We are early stage, but we will have 3,000 units out on the Cent Cloud this time next year. So we take check sizes anywhere from $25,000 upwards. We close this out in the next couple of months. So that's Auric. We're at the forefront of personalised scent technology. Thank you very much for your time.
Hi, my name is Frances MacDonald and I'm a founder and director at Capstone Income Fund. Capstone Income Fund is an Australian real estate debt fund, and real estate debt is a great asset to add to your portfolio because it offers double-digit returns, it has less volatility than equities, greater yield than fixed income, and overall is a great diversification strategy for your investment portfolio. Let me get into who we are and what we do. I'll skip over the T's and C's and go into what is this opportunity that's available. And there is a unique opportunity for non-bank lenders in the market to generate outsized returns. And that's because traditional banks have retreated from certain segments of the market that has allowed non-bank lenders to come in and realise returns at a premium to those received by banks in underserved parts of the market. And also borrowers in some segments really favour non-bank lenders for their speed and their flexibility. On the investor side, private credit has been the alternative asset class of 2023. In the period we've had of volatility, inflation and macroeconomic uncertainty, private credit has been very attractive as a yield strategy and diversification source. At Capstone Income Fund, our fundamental strategy is to deliver outsized returns relative to risk to our investors. We do that through investing in a diversified portfolio of registered mortgages. We target higher interest rate short-term loans. Our loans are generally 6 to 12 months in tenor, and that actually minimises our risk profile because it means we are less exposed to longer-term market volatility, and we're generally very aligned with our borrowers on the exit of the loans. The majority of our portfolio is first-ranking security, which means we are first in line to be able to take over an asset to recoup our principal and our interest in if we need to. And we have very strong capital preservation in our fund. Not only do we invest in very deep liquid areas around key cities, but we also have a conservative LVR, which is our loan to value ratio of 60%, meaning there is $100 of value underpinning your investment for every $60 we've lent, giving significant headroom for market fluctuations. Our offer to our investor base is a consistent, high-yield, passive income stream of 10% per annum. We have a very flexible product, giving monthly distributions and no lock-in periods. And a really attractive thing about real estate debt is the level of security underpinning your investment. At Capstone Income Fund, we have multiple lines of defence. We have a conservative LVR backed by real assets. We're primarily first mortgages. We have strong processes in place. We have strong contractual protections, and also management is invested as a first loss investor. That means our capital is at risk before there's any risk to investors investor capital, offering true skin in the game and another line of defense on your investment. Now let's take a step back and go, why would you invest in real estate debt? Rather than going, for example, direct property investment, which has long been a source of resilience and growth for investors. Investing in a real estate debt fund allows you to get exposure to the property market while minimizing the risk and effort. It has greater liquidity and lower upfront costs when compared to if you were to purchase a property directly. Now, the key thing that I find really attractive about real estate debt is, one, it is an asset-backed security. There are real assets underpinning your investment. Second, debt is higher up in the capital stack, and if anything goes wrong, we are repaid first. So you see on the right-hand side, equity takes more of the price volatility, while debt doesn't look to underperform or overperform, but we are repaid first, lowering the risk profile. The third thing that's really important in debt is the loan-to-value ratio, that we always lend to something where there is more value than our loan, so that can give us more headroom for the ups and downs of the market. From a returns perspective, real estate debt is high yield and has less volatility than other asset classes. What you can see on this slide is the most recent term deposit rate of 4.55%. That is quite equivalent to a risk-free rate, and you can see on the right-hand side how that compounds over time. Equities in comparison, here we're looking at the Australian All Ordinaries over the last 5 years, and that's been extremely volatile. We've had recovery in most recent times, but due to the volatile nature of equities, it's always good to balance your portfolio with other assets to act as a shock absorber. Real estate debt and Capstone Income Fund in particular, what we see here is a consistent compounding 10% return. That offers a really stable, reliable, regular income source where you can see how that grows over time, and that's really attractive about real estate debt. Just to give you a little bit more flavour of actually what do we do and what do we invest in. As I've mentioned, we have a diversified portfolio of short tenor loans, generally 6 to 12 months, and some of our key categories are residual stock, bridging loans and land deals. What you can see here is some of the assets that we have invested in. So on the left-hand side, this is a wonderful apartment building in Redcliffe, Queensland. Queensland, as many would know, has had a boom in the property market. In this asset, the developer has finished the construction of an apartment building, and their construction facility has come to an end, and they need a short loan to get them through the sale of the remaining apartments. You'll see in this one, we have a value of 2.6 million, term of 12 months, and an LVR of 66%. This is a great asset for our fund because it's a very low risk profile. In this instance, a number of the apartments were actually already pre-sold, so you've got a really good indicator of value, and the exit's very clear. In the middle, you see a beautiful building in Mosman. This is a bridging loan, 3.6 million of value, a very short term, and a very low LVR. So again, a very clear exit for this loan. On the third category, you see a land deal that we've done in New South Wales for 2.5 million. In this instance, the developer was in between planning approvals, and once they got their DA, they would then refinance to a construction facility. With land deals, we always look to have a lower LVR, given it is a land deal. So that's an example of what we do. Some of the key takeaways about our fund that I want to leave you with is we have a 10% return with very strong risk metrics of 60% portfolio LVR. Over 85% of our portfolio is first registered mortgages. We have a strong track record in place. We've been operating over 5 years as a non-bank lender. We've done nearly 100 loans actually with no capital loss, and we've always met our 10% return in this fund. We are putting our money where our mouth is, and management is invested as a first loss investor, offering another line of defense to your investment and showing that we really stand behind our business model. And we also seek to offer a really flexible product to our investors, meaning there is no lock-in period, and also you get monthly distributions so you can see that return coming into your account every month. We are open to wholesale investors with investments starting from $100,000. I'd love to have a chat with anyone who's interested, so please reach out or come and download IM. Thank you.
Hello, I'm Angela.
And I'm Elijah.
And we're the co-founders of Bubzi Co. Bubzi Co is an e-commerce baby brand that uses data to design high-demand products. We're excited to present to you today on our scale-up opportunity to turn Bubzi Co into Australia's next global household brand. Let's talk about the problem that we're solving for. When you're a first-time parent, buying baby products is overwhelming and extremely confusing. The market is cluttered and you're not sure who to trust. Gen Z and millennial parents are busy working professionals and find the experience of shopping in a big baby store tiring and overwhelming.
That's why all the big baby stores like Bye Bye Baby and Babies R Us have all gone out of business. And now all new parents actually shop on Amazon.com. In fact, 80% of new parents set up their registries on Amazon, and 1 in 3 purchases take place on Amazon. There are 367 million searches a year on just the keyword baby nursery.
Given this, introducing Bubzi Co. We're the biggest baby brand you've never heard of until now. We're proud to say that we're a top 1% baby brand on Amazon. Since 2016, we have served 1 million customers, achieved 6 million AUD in annual revenue with over 36 million in combined sales, and have had the rare position of 30,000 product reviews. Our vision is to own the nursery room.
So what's our edge and what's our secret sauce? We have a proprietary method of analyzing Amazon data to inform the design of every product we make. For example, this Owl Soother that we created is a result of deep data analysis. The data can tell us things like market demand, estimated sales and profit, competitor performance, what features people want and what price they will pay, all before spending $1 on designing the product. This reduces the risk and expenses to ensure that every product we launch is a winner.
Our business model is lean. Our products are designed in Australia, manufactured overseas, then transported to freight forwarders that drip feed into Amazon warehouses. Amazon delivers the product to the customer, eliminating the need for heavy investment into expensive fixed costs like warehouse and delivery, which means our model is super scalable globally.
We are experts at selling on Amazon. In fact, one Bubzi product sells every 2 minutes, with 13,000 units on average sold a month, and an average product page conversion rate of up to 25%. This is extremely high compared to a traditional D2C website, which has a 2% conversion rate on average.
Our customers are Gen Z and millennial parents, as well as grandparents and gift givers. And we're already global. 50% of our sales are in the US and 50% are in the UK and Europe. We have a small percentage of sales in Australia. There's still an immense opportunity to grow with a $15 billion annual serviceable market in the US alone, as new parents spend an average $5,000 on their nursery, and they're spending it on Amazon.
So who are we? Our team is made up of parents who are passionate about providing exceptional experiences to our customers and building global brands. We're a lean team of myself, Angela, and a team of remote contractors in finance, sourcing, and customer happiness. So let's talk about our traction. We've bootstrapped this business since 2016 with a credit card. In our first year, we achieved $3.4 million in sales just from 2 products. Then we grew by $1 million every year until we hit COVID, and we dealt with the headwinds as best as we could. We have maintained strong, consistent sales since then and are on track to hit $7 million in FY26. Our gross margin is 75% and our contribution margin of 40%. Recently, our growth plateaued by a lack of long-term capital, having to pay back high interest loans within short time frames. That's why we're looking to raise capital with investors who are ready to build upon Bubzi's strong foundation.
So how will we grow? By building upon the strong foundation and moat we have established until now, we will grow by expanding the product line, diversifying channels into retail wholesale, and expanding the markets into Asia.
We have a 30x growth ambition to become a household brand. As Angela has mentioned, we'll take a 3-pronged approach to grow the brand to over $100 million. Phase 1 will be launching new products. Phase 2, wholesale, retail, and distribution. Phase 3, Asia market expansion, all while working on building brand equity through meaningful content. Another thing we wanted to highlight is an opportunity that we're super excited about, the launch of the Bubzi Co baby wipes. Our customers buy their baby wipes on Amazon through a subscription model, and now with our expertise and brand equity on Amazon, we are going in to conquer the baby wipes category. To give you an idea of how big it is, the top 2 brands on Amazon USA both make $100 million a year. We believe we can take a significant portion of this market.
Our Bubzi baby wipes are biodegradable with recyclable packet and will be the highest quality baby wipe that's both soft and strong. We've secured a manufacturer in Korea and can produce this product with attractive margins. The estimated sales uplift from this launch will be $1 million in year 1 with an estimated LTV of $1,000 per customer.
To achieve this next phase of growth to $20 million, we are raising 2 million AUD equity and/or debt, and will use the funding for new product development, inventory, a few team hires, and marketing. Because we have laid such a strong foundation in our current business and are profitable, we believe investors will be able to benefit from fast growth, as we've already proven product market fit and are masters of the Amazon game. Once we hit $20 million in revenue, we'll be open to liquidity events such as PE, partial sale, or further growth equity.
So to recap on this exciting opportunity to join us, I want to remind you that 80% of baby registries are being set up on Amazon today. Bubzico is an established 1% top brand on Amazon with 30,000 reviews. And this is like online real estate. And for a competitor to come in now and try and replicate this is almost impossible. We are already global, we have strong revenue and are profitable. All we need to do is double down on what we do well and grow Bubzico into Australia's next iconic baby brand.
Thank you for your time today, and to book a call with us, please scan the QR code or contact us via email or Wholesale Investor.
Thank you.
Hi there, my name is John Nguyen, Managing Director of Atlasia Capital, and I'm glad to be speaking with you today about our childcare property debt fund. A big thank you to the team at Capital HQ for bringing this online event to life. In a world where geography and time zones are no longer barriers, we're presented with endless opportunities to connect, collaborate, and create meaningful impact like never before. I'll start with a quick disclaimer. The following presentation is intended for wholesale clients only. It provides general information about the Childcare Property Debt Fund and does not constitute financial advice or a recommendation. And now, I'd like to introduce you to Atlasia Capital, an emerging fund manager dedicated to investments within the childcare industry. For our inaugural fund, we are targeting a return of 15% per annum net of all fees over a loan term of up to 2 years. Our total raise target is 20 million, consisting of individual raises between 1 and 3 million. So for the next 7 minutes or so, I'll be sharp with the message. I'll share with you the opportunity and talk a bit about our team and strategy and show you why we have picked this sector as our investment niche. Now, just some background around the team, key persons being myself and my business partner. My origins are non-traditional for a fund manager. My bachelor degree is in optometry, having grown my network of clinics to 7 across Sydney. And the day I heard about childcare, I quickly realized the potential and scalability of this sector. So over the past 2.5 years, I acquired multiple childcare property development sites around Australia, became an accredited childcare provider, started a fund, and thus became a fund manager. And Richard Toe, our co-director, is a seasoned industry veteran with 20 years in childcare operations and childcare property development. Our edge at Atlasia Capital is our 360-degree understanding of childcare. This multi-decade experience provides insights that enhance our site selection and project forecasting. Our fund has been set up with an outlook for long-term success. We're proud to collaborate with notable firms that share in our vision. Polar 993 for trustee, AFSL and fund admin services, K&L Gates for legal advice, A&M for taxation, and EY as our auditors. Okay, so what is it about childcare then? Why are we so committed to it? Childcare is a $17 billion industry. For Australians, childcare as a service is as essential as they come. Luckily for Australians, our government subsidised childcare fees, up to 90% cover in many cases. So for families, kids go to childcare. It's a fact of life. And arguably, the biggest beneficiary of all is the Australian government. The official models show that the recent $1.7 billion increase to government childcare subsidies will boost the economy by $1.5 billion a year. Australian governments have a big problem that they need to avoid. That is, the potential loss of revenue to the economy, as well as the potential negative social impacts that may follow. So we want to be part of the solution. Childcare businesses are highly profitable. We know the centres we build, the business owners will generate somewhere around $1 million in net profits per centre. So demands from families is increasing and demand by operators is increasing. On top of that, the data shows that childcare services are vastly undersupplied around the country. Up to 9 million Australians, over a third of the nation, live in areas of childcare undersupply. It is a highly regulated industry, making it difficult for new entrants. So it's simple economics. Demand is high, supply is low for this essential sector, and government support is increasing. The Childcare Property Debt Fund will help supply the construction finance needed for our related childcare development companies, and this will aim to deliver a 15% return per annum net of all fees for unit holders. The fund will finance DA-approved, permit-ready childcare sites with a defined exit, secured with a second mortgage over the property at a max LVR of 70%. The projects will be funded with a mix of lending. A bank will provide the majority of project funds and will hold the first mortgage. The fund will provide additional finance, commonly referred to as mezzanine finance, and take second mortgage. Then the balance will be funded by the developer's equity. In turn, at completion of the project, repayment of capital will be paid in that order: bank, fund, and then finally developer. Here we've provided an example of typical funding percentages from each source. This will vary with each project. The bank lender will normally finance around 60% of the total development costs. The developer will typically need to contribute 20% of development costs, i.e. have skin in the game, and the balance is to be financed with a loan from the fund. This fund will be investing in projects managed and operated by related parties to Atlasia Capital. This co-investment essentially dictates an alignment of goals with investors, since our success is only realised at the end of a project after return of capital. On that note, here is a quick overview of the key facts of the fund. Most of these points we have touched on already. The fund is open to wholesale investors only, with a minimum investment of $100,000 Australian. Full disclosure of fees and risks are outlined in our information memorandum. We anticipate a steady pipeline of projects ready for investment. Each capital raise will be issued a separate appendix specific to the project alongside the information memorandum. Separate unit classes will be issued for each raise. So the important thing to understand here is no investment will be affected by the performance of another. So if an allocation towards a target 15% per annum net of all fees lend product within the childcare space is of interest, please contact us. We'd love to align our values with like-minded investors. Our team is dedicated to closing the gap in childcare undersupply in Australia. Let us know if this resonates, and we can provide our disclosure documents and have a detailed discussion on how the fund is structured, risks, and mitigation strategies. Again, my name is John Nguyen, Managing Director of Atlasia Capital, and thank you for having me here with you today.
Hello everybody, I'm Michael Dragon from ProductHub. Bit of background to how we got to ProductHub. I grew up I was a troublesome child. I think my mum sent me to work with my dad at our hardware store at about 8 years old, and did all the driving forklifts instead of learning what I was meant to do. but through that, I developed a bit of a skill for products and an interest for products. When I was about 12, we were very early on in the IT space. My dad was an immigrant Italian with a suitcase, still can't send an email. But back in the day when I was still in high school, we had point of sale when Woolworths and Coles were still putting 29 cents on a can of baked beans with a pricing gun. Moving on from that, later on we developed more IT. I sorted out all our ordering and all of that. So I have this interest with that. With products, where they come from, who owns them, all of that should have better hobbies, but that's what I've got. How this comes back is when COVID hit a few years ago, I wrote an app to help people find out what was Australian and the like. And from that, I had to source data for a number of products and find where this information was and work out how to sort it out. What I discovered was there's a huge data, requirement for products. There's 1 million plus nearly 2 million companies using barcodes. There's over 1 billion products, but these are all over the place. There's an organisation that does your barcoding. We've heard from a couple of presenters today that are using barcodes, but the company that does that is actually called GS1, which stands for Global Standards. There's 118 offices around the world, and the one thing they don't have is a standard. They have around 7 or 8 common bits of information they use, but it's not stored in a way that everybody has access to it, and the supply chain struggles to keep up with all the information they need to transfer around the place to share and make commerce work. So just a couple of the stats you can see. Our database, we've got 60 million products in our platform already. That's mainly from Australia and US, and we're bringing in the rest of the world over the next 6 to 12 months, where we'll get over 1 billion products in our platform from over 1 million companies. We have I don't know if anybody knows, but barcodes are scanned over 6 billion times a day. They're integral to everything that happens in retail and in trade around the world. As far as the market goes, product data management, as you can see here, Precedence Research have done the research, and at the moment it's about a $17 billion a year industry with some big players. That over the next 10 years is going to grow to over $106 billion, and there's a lot of people that need more and more information to facilitate e-commerce and trade and all of that along the way. Everybody along the supply chain uses barcodes. That's from the people who are making the stuff through to your transport companies and the logistics, your retailers, your distributors, your wholesalers, and the end user to a point. So it's a big segment. There's a lot of information required for people. And the one problem we've got is everybody's working from data that's shared from different sources, and no one knows what the truth is. So, as we've said, GS1 is the worldwide organisation. It's a not-for-profit run out of Belgium. They manage barcodes, licensing around the world, and barcodes give traceability and a whole lot of other things, but it's a starting point for everything. Whether it's a box of a carton of them or a single unit, there's a lot of information that goes behind the barcode, and it's just a matter, it's probably the most boring bit of the product, but it's the most exciting when it comes to telling you what's what and where it all comes from and where it all goes. With GS1, we have a relationship with GS1 Australia. We're an associate alliance partner, which they've recognised that we've got some idea what we're doing. But more importantly, we are one of only 10 companies worldwide. We're executive solution partners with GS1 USA. So we have direct access to 330,000 American companies and a whole lot of systems. The Americans are not the head office, but they're the main player in the barcode world, determining which way the barcodes go, and we've got a great relationship with them. Our target users. We have a lot of targets because, as I said, the supply chain along the way, everybody needs the information that's behind the barcode, whether it's the producers. I'll go through this. This is available in our deal room, so you can just get this afterwards. There's a lot of words. Where you've got producers and suppliers, they're the ones that set the tone. They provide the information. They are our main target because we want to get their information. We source the information from GS1. We improve it. We use a lot of AI to clean it up and categorize it and do all of that. But the suppliers are the ones that sign up with us and guarantee that their information is correct. From there, it goes to transport companies have to move it. They need the pallet sizes, the weights, and a whole lot of stuff. So they're looking to us to get that information to make sure their shipping and their transport and all the parts they take care of are efficient, and they're not getting products showing up they don't know the size, the shape, the like. You've got your logistics companies who have warehouses full of products. They need to know this. I don't want to bore you with the intricacies of a barcode, but they need to know if they scan that barcode, is it a box of 12, is it a pallet, is it a single, all of that. So we give them all that information in a very concise, simple way, very accurate and easy for them to use. And there's a whole lot of information they use. From there, you've got your distributors who are out trying to sell it, your wholesalers who are trying to do it. They need all that information, all the bits and pieces. So they are another target that will pay us for being on our platform. With that, you've then got the retailers. So our platform looks after not only the data, but also the documentation, the imaging, everything that all these parties need. So that's all in our system. And again, end users, whether they're looking for research or whatever, our system, we have a search engine, which what we're sort of aiming to do is if people want to buy tickets for the Hoodoo Gurus, they go to Google. But if you want to do some product research and you want to know what you're buying, you come to the ProductHub search engine where you get unbiased, ad-free information. So that's another good plus for us. So this is where it all started. An example, once we've got the data, there's also endless opportunities that are coming to us where people want the data to base their platforms, their initiatives on. And that's also another stream for us where once we have the data and once we have that, we can partner with people as we see appropriate to make more opportunities from that. So that's a short and sharp presentation. We're out the back here, so if you want to come and have a chat, and there's so much to what we're building and what we're delivering and the opportunities that come from this. To say it's a big opportunity is very taking it easy. Thank you very much.
Thank you very much for that, and thank you very much for your time and listening. My name's Andrew Mortimer. I'm the chairman of Advanced Metals Technology Group. And thank you very much to Steve and the Wholesale investor team for putting on this conference, Future Disruptors. It's certainly a very important topic to be talking about right now, especially with all the companies here, but also because the disruption is very much happening now. It's not just in the future. We all as companies want to disrupt, but the reality is that things are changing very much now. I'll just take you through a few quick points. Essentially, mining, energy, and transport globally is about $14 trillion per annum. It's a gigantic aggregate market. But the reality is that because things are changing significantly, it's not just a matter of that market growing on an annual basis at a percentage of 5% or 10%. The fact of the matter is that people across the globe are looking for us to change and re-industrialize around the electrical engine, okay, and swap out the internal combustion engine, the ICE. Now, that can only be done with very large amounts of materials like rare earths, nickel, cobalt, copper, lithium, graphite, magnesium, and a range of other critical metals. Essentially, Advanced Metals is an advanced explorer. but we also work on mineral processing technology as well, where we look to process the material of tailings dams and produce more with the same amount. We can't afford essentially anymore to be leaving vast amounts of material in tailings dams. They're not just unsightly and environmentally unfriendly, but they are a waste. Now, we are a polymetallic company. I'll take you through that in a moment, but essentially one of the ways we produce more with the same is because we're not tied to one single commodity. Right? So we either look for nickel, copper, platinum, palladium together, or copper, gold, silver, lead, zinc. And I'll take you through our two flagship projects in a moment. Many of you be aware that there's a gold boom on at the moment as well. Gold's hit $2,800 an ounce. That has other reasoning behind it, like the proliferation of fiat currencies through money printing and through digital assets like Bitcoin and a range of other Web3 products that basically increase people's desire to have the value aspects, store of wealth of gold. But essentially, as I've said, with artificial intelligence and the data centers they require, they also require vast amounts of electricity, electrical energy, electrons, and obviously copper and a range of other metals to produce that electricity and then carry it to those data centers. Right? It's not just a matter of creating an app for it or software. There actually has to be the hardware to back it up. And that's why this market is so large. The IEA says that electricity consumption is going to increase sixfold over the next decade or so, and that we need to increase our production of these metals by 300% by 2030. Now, that's a threefold increase in about 5 or 6 years. Let's see if we can do it. But it's only with a lot of extra corporate work by companies like Advanced Metals that we have any chance of getting there. That's the reality. So at this time, Advanced Metals Technology Group is one of the companies that is basically trying to disrupt the mining industry and accelerate the process of finding mines and then accelerating them down the production path. Now, our first project, the Baldwin Hills project, is in Western Australia, and it's in the Western Yilgarn. It's nickel, copper, platinum, palladium, so it's polymetallic, and it's about 250 kilometres northeast of Perth. We've got Chalice Mining to the north of us, but also to the south of us with their Julimar project. They're capped at about $600 million on the Australian Stock Exchange, and they've got a very large resource of nickel, copper, cobalt, platinum, palladium, and gold. But it is low grade, and we are looking for the high grade, massive sulfide opportunity in the Western Yilgarn. We believe it's there. At Baldwin Hills, we found a 1 to 1.2 square kilometre anomaly of nickel, copper, cobalt, platinum, palladium through drilling, and we'll be doing another 1,000 metres on that before Christmas. Essentially, that whole area is being hotly explored at the moment because it will produce the lowest quartile metals, being so close to people, power, port, and road facilities. So that whole area in Western Australia is very interesting, and our project there, which is certainly not greenfields, we've done quite a bit of work on, and it has received Western Australian grant funding in the past, and we expect that we can have a quick result there either way. Now, our second flagship project is in New South Wales. It's the Havilah Copper Gold project near Imugene. It's close to Australia's largest undeveloped silver deposit, which is going down the development path now. And this is a ex-Newmont project. They're still there as a joint venture partner and a royalty holder through one of their groups. They did the early exploration and now we're carrying it on. We've done a ground electromagnetic survey, and we found quite a nice electromagnetic anomaly there. We do receive quite a lot of unsolicited approaches from other companies who are looking to joint venture in on our projects, and so that one especially, but the others as well. That is our process for basically creating value for shareholders. It's these mines that we have, these opportunities we have now, are likely to be joint ventured, okay? Where we keep a retained interest and we receive a payment in cash and shares for them, and that is how we create value and become self-sustaining. Now, essentially, the numbers I quoted you before about needing to increase our metal production significantly by 2030, that can only happen through a disruptive approach, accelerating discoveries, which we've done, and then accelerating them through to a mid-tier or a major to put those projects into production. That's really the only way it can happen. A company like us can't wait 10, 15 years issuing more and more shares to put a project into production. So essentially, our ask is $750,000 at 3 cents. We expect this will be either our last or second last raising to become self-sustaining. We can, with that money, do 2 more project acquisitions, but from there, joint ventures should take us through to cash flow positivity. Thank you very much.
Imagine turning what the world throws away into something the world can't live without. Millions of tons of waste paper are discarded yearly, while the demand for sustainable materials skyrockets. I'm Alf Wheeler, co-founder and CEO of Zeo, with 40 years of experience in the raw materials industry, helping manufacturers meet their needs. At Zeo, we've unlocked the potential to turn waste into high-value, eco-friendly products, benefiting the planet and driving real business growth. Now, you can be a part of the solution and profit from a cleaner, greener future. Zeo is revolutionizing sustainable manufacturing through ZMP technology. We're taking waste paper, a highly recyclable, yet often downcycled or underutilized material, and turning it into a premium, petrochemical-free product. Our unique Cellulose Valley model promotes rapid scalability, creating local hubs that produce sustainable products while maintaining high standards. Imagine a world where eco-friendly, plant-based products are the norm. That's the future Zeo is leading. We're facing some critical global challenges. Every year, we consume 100 billion tons of materials. Less than 20% of that is renewable, and only 7% contributes to the circular economy. Demand for sustainable products is growing fast, with stricter laws on the horizon, but consumption isn't going anywhere. We need to power industries and create jobs, whilst also cutting waste. The solution lies in cellulose. Cellulose is the most abundant polymer on Earth. 150 billion tons of it are produced naturally every year, and we've been using it for thousands of years, from papyrus to modern paper making. What's more, there's already massive infrastructure in place globally, with over 500 mills producing 200 million tons annually. Cellulose is a super material, strong, lightweight, biodegradable, and renewable. We're not reinventing the wheel, we're making it better. Our secret is Zeoform Micropulp. We've adapted existing paper-making technology to transform ordinary cellulose fibers into ZMP, a moldable, versatile material made from cellulose and water and nothing else. And the possibilities? Endless. From furniture to consumer products, ZMP is ready to make an impact. I'd like to show you some of the stunning products we've created with Zeoform. We're building a flagship factory to prove how using ZMP can not only benefit the environment, but also be profitable. Once we show the success of this model, we're ready to scale, providing everything needed: equipment, resources, know-how, and of course, ZMP. Here are some of our award-winning designs, including the Natura collection, which was recently recognized at the Good Design Awards. The global furniture market alone was valued at $548 billion in 2021 and is expected to grow to $780 billion by 2030. We're targeting just 1% of that, $6 to $8 billion, and plan to expand into other sectors as well. When we look at the furniture market, materials like timber, metal, and plastic dominate. Timber alone makes up 40 to 60%, while plastic accounts for 10 to 20%. This represents a massive opportunity for Zeo. Instead of aiming to replace these materials entirely, we see a chance to take a chunk from each sector by offering ZMP as a sustainable, high-performance alternative. Even capturing a small amount of these massive categories can translate into significant market share and revenue for Zeo. The demand for eco-friendly alternatives is growing, and we're well positioned to meet that demand by substituting traditional materials with our authentic, renewable solution. We've already partnered with notable brands like Tigme Trading with the Natura collection, and have projects in the pipeline with Southdrawn and Durlot launching at the end of 2024. We've made significant strides from developing ZMP to producing glue-free boards and implementing 6-axis robotics in our manufacturing. These innovations keep us at the forefront of Industry 4.0 developments and align with our mission to create a world-leading, high-quality, franchisable business model. This model can help numerous industries transform their processes into more sustainable ones. Moving forward, our focus is on scaling production and expanding our showcase factory in Australia. Automation will drive our efficiency and support the Cellulose Valley ecosystem. Our plan for 2026 is to establish the first Cellulose Valley in Europe, a collaborative ecosystem where strategic partners, factories, and franchisees work together to drive innovation and product development. This initiative will pave the way for sustainable manufacturing, fostering social and economic success. We're looking for partners who share our vision and are ready to play their role in transforming their industries. To achieve our goals, we're seeking $10 million in this Series B round in exchange for 15% equity. Our valuation is $66 million, supported by conservative projections, our proprietary technology, and the significant value of our intellectual property. We plan to utilize the funds strategically to enhance operations and support our growth. First, we'll upgrade our pilot plant into a showcase factory to demonstrate our unique capabilities. We'll also invest in acquiring key personnel to strengthen our team and cover all operating expenses over the next 3 years. Additionally, we'll advance our manufacturing processes and develop a comprehensive franchise package for our IP, enabling scalable growth. A 6-month global marketing campaign will be launched, including participation in multiple design shows to build awareness and engagement. Lastly, we'll provide an option for early investors to realize returns on their investment as we continue to grow. Our business model is built on 3 key pillars that support our growth and sustainability. The first is franchising. We'll monetize ZMP by franchising, earning revenue from fees and royalties, and of course, ZMP sales. This allows us to scale rapidly by empowering partners to create sustainable products while maintaining brand integrity. The second is contract manufacturing. Partnering with well-established positioned brands will help us grow market recognition by association. This strategy boosts our visibility and contributes to these brands' sustainability initiatives. And the third is through Zeo products. Developing unique, market-ready products allows us to offer custom solutions to businesses aiming to meet their sustainability goals. This also serves as a platform to showcase ZMP's versatility and inspire new applications. At Zeo, we aim to create a sustainable future while delivering strong financial returns. We believe profitability and purpose can work together to drive business success and positive environmental impact. With a targeted IPO or strategic sale in 5 to 6 years, we're positioned to leverage market momentum. Our projected ROI of 5 to 10 times reflects the rising demand for sustainable solutions and the scalability of our model. By upcycling waste paper into Zeoform micropulp, we help businesses lower their environmental impact and meet the growing demand for eco-friendly products. Investing in Zeo means joining a transformative journey to redefine industries, achieve meaningful returns, and make a positive impact on the planet. I'd like to introduce you to the remarkable team behind Zeo who drive this vision forward with their diverse expertise and passion for sustainability and innovation. Thank you for your time and attention. We appreciate your interest in Zeo and our vision for a sustainable future. If this sounds too good to be true, we invite you to visit our stand, table number 4, where you can see and feel a showcase of Zeo products firsthand. Together, we can make a meaningful impact on the environment while achieving significant financial success. We welcome your questions and look forward to discussing how you can be part of our journey toward a more sustainable planet. Thank you.
Okay, so we have a room full of investors, some founders, so I think this would be an appropriate opening. If you could just find someone close to you to have a quick conversation with. I want you to reflect on the last decision you made that cost you a substantial amount of money. I know that's probably a very uncomfortable thing to share, but let's jump straight into it. I'll give you about 30 seconds to have that conversation. If that was a decision that came to mind pretty damn quickly, a moment that was quite easy for you to identify, a decision that if you could go back in time and think if I was able to make that decision with a bit more awareness, a bit less reactivity, that really could have potentially changed the trajectory of that deal, or maybe even the trajectory of a relationship, or in some cases, even your life. Hands up if you believe that you're a rational person. Okay, so we've got about half the room that are totally deluded. All human beings are very driven by emotion. Different reports from Gallup and Deloitte will say anywhere between 80% and 95% of our decision-making is emotional. InTruth Technologies is the first company in the world that can track emotion through consumer-grade wearables passively. What this means is right now, InTruth is tracking my emotional state millisecond by millisecond, and it's able to produce a report that allows me to see a very granular map of how my emotions have fluctuated throughout my minute, hour, day, week, etc. And once that data is aggregated, to actually look at the emotional patterns that govern my life. Now, why is this important? As I said, emotions driving the majority of our decision making every single day. Imagine if what's currently unconscious to you could actually start to move to the conscious mind, could actually start to become something that wasn't just driving you in a way that was invisible, but actually became something that is visible. And when you look at the people throughout history that have been able to master this, it's people ultimately that have devoted themselves to very precise practices and disciplines that in an everyday context is becoming harder and harder for us to understand because the level of stimulus that we're exposed to every day is becoming astronomical. And what this means is companies, social media, advertisers are dependent on you actually outsourcing your awareness, becoming emotionally triggered and using that to basically drive you to consume and behave in ways that maybe if you were able to regain a sense of sovereignty, you wouldn't choose for yourself. I really believe that InTruth is solving the problem behind all problems. Many visionaries and innovators are looking to the world and thinking, how do I change the state of the world? But what we fail to recognize is that the state of the world actually begins with that emotional reaction that very, very few of us have control over. There have been many pitches today that have talked about some of the astronomical issues around mental health and emotional well-being globally, and we know this is an issue. Whether it's something that you're dealing with yourself or it's someone in a very close proximity to you, it's not difficult to identify that this is a problem. But where the downfall is all of the solutions are trying to essentially put a band-aid over something that is highly complex and, for the most part, not something that we've been able to consciously understand. And my background has always been as an entrepreneur in mental health, and my first organization led me actually to serve as a federal mental health commissioner here in Australia for 3 terms. And when I stepped into that role, I could really see the degree of crisis that the system was trying to handle. 97 cents of every dollar in Australia was going to crisis management and intervention. And it was through those years, partnered with the work that I did with my first organization, which was looking at mental health solutions in communities, really looking at how building capacity in communities could actually support mental health outcomes. So teaching communities what I called at the time emotional infrastructure, and looking at how that reduced things like suicide, addiction, and ultimately increased things like attendance in school and supported economy. And of course, there were profound correlations. That was the work that led me to work with the commission. But over those years, I noticed inextricably that there was no solutions that could actually solve this at scale. And the deeper I went on to understand emotion and its how heavily our behavior is dependent on emotion, I started to recognize that it's really no wonder that this is the issue it is. Because this question I had as a founder throughout my entrepreneurial journey is, why don't we have higher levels of emotional intelligence? And what I've come to understand actually is very few of us understand what emotion is. And in talking to people about InTruth, it's so often the question, why would we need to understand our emotion? Why would we want to become aware of our emotion? And I think in that question, in lies kind of the level of challenge and problem that we're actually dealing with as a world. Billions have been spent on fitness trackers and sleep trackers, but when you really think about the change required to shift some of those data points, i.e. if your Oura ring is telling you had a bad night's sleep for the 10th night in a row, or you can see that your autonomic nervous system is out of balance and out of kilter, or that you're not getting your steps in for the day. Ultimately, the thing that's going to drive true behavioral change in those areas is to understand why there's emotional dysregulation in those areas. Just like when we interview doctors and we ask what is the biggest pain point you have with your patients, they will always say, well, we tell the patient what to do, but they don't do it. So there's an issue, there's a breakdown with behavior, which is actually an emotional problem. And here's why. This is what I've come to understand about emotion. Emotion is a response to raw stimulus that's happening every 200 milliseconds. By the time someone's asked you, how are you feeling, you've actually experienced up to 50 emotions. And then we say happy, and we expect to sort of aggregate and simplify something that's very, very complex. And never before has a company been able to touch the data underneath that, which is what InTruth is doing for the first time. So no matter your field, I'm assuming that as innovators, you're working towards state change of some kind. But what I encourage you to look at is actually where state change begins. State change begins in that raw emotion that's being a response to stimulus, which InTruth is able to capture for the first time. This is what emotion is made up of: valence and arousal. Now, this graph is called the circumplex model of emotion. What's fascinating about the circumplex model of emotion is there's never been a universally mapped circumplex model of emotion. In all of the efforts to progress things like neuroscience and understanding of behavior of a human being, every single circumplex model that you see up until InTruth is basically guesswork. Whereas we've found a way for the first time to actually map objective valence and arousal data points at scale. So one of the outputs of our tech isn't just the consumer product, isn't just the implications in how this is going to transform B2B markets, but actually, for the first time, we're going to have a true understanding of what emotion really is objectively. So when I can see your data and you can see my data, we're able to actually develop empathy. And you can see the difference. This is my data set versus our chief science officer. You can see a founder profile versus a scientist. And you can see, just how easy miscommunication could be when you compare these two types of personalities together. This is something I love to show as well. This is my partner and I's data. And you can actually see that over time, our inTruth data started to sync. And what this is proof of is co-regulation. So you can actually start to see that when you're surrounded by people, the people you're surrounded by, you truly do become a product of. Now imagine the implication of being able to have visibility over that in teams. I'm just conscious of time, so I'm going to just move straight to the market opportunity. So the wearables market is a young market, but it's already valued at $560 billion. It's compounding at about 15% annually. And what's very unique about inTruth is we're a software company. So we build the machine learning that pulls raw data from the wearables, raw IBI data, restructures it through ML, and then feeds that back to the user. Most of the companies that are owning the wearables market at the moment are hardware companies, all of which we can technically integrate with because they have the right sensor. What this means on the consumer side is we have an opportunity to really become an unprecedented success story in the wearable space. If we get 1% of the market using inTruth, which we believe is very doable, Whoop, for instance, has a 12% market share, so we'd need less than 10% of Whoop users using inTruth. We're turning over about $500 million in ARR. We already have a pipeline of 55,000 first responders that are ready to use this tech, and a series of other high-profile corporates who are wanting to do pilots with us, as well as research projects. Brain Vector actually gave us a shout-out earlier, so thank you for that, which is very exciting. So we're raising a $2 million bridge at the moment to get us through to next year, when we're receiving a $9.1 million research grant. We've already raised 3.8 million Australian, so we're needing the bridge basically to build the capacity to take this product to market and start to serve the clients on our wait list. Thank you.
So maybe you just saw me walking onto stage and you thought, is this guy drunk? Well, I actually got that a few times. Not being drunk on stage, of course, but being perceived as because of the funny way I walk. I was actually born with a genetic difference called SMA type 3, which gave me a physical disadvantage. And I can tell you, you need to be pretty strong in your head to overcome normal day-to-day situations. But it has given me an amazing superpower, the superpower to think outside of the box. From a young child onwards, I had to do things in a slightly different way to just overcome normal day-to-day life situations, jump over life obstacles. Well, actually, not jumping, but looking at them from a unique perspective. Hi, my name is Dan.
Hi, everyone. I'm Steph. I'm a medical doctor specialized in neurology. I'm not his neurologist. I'm his friend. Before being a medical doctor, I was a pilot at the Air Force. And I can tell you flying a high-performance jet is asking a lot of mental strongness and well-being. When I was seeing patients, I also saw patients with very, very challenging mental health issues. Me, personally, I was practicing Tai Chi to try to keep my high performance and well-being. But you can imagine a world where you can, anytime, living a boost of positive emotions, and that can be accessible for everyone. Let's have a quick look at the video, because I think the video will explain you better.
What if we could use positive memories as a weapon to suppress certain symptoms associated with mood disorders like depression?
Harnessing the power of Brain Vector, we are tackling a universal crisis, mental health. A concern affecting half the global population at a cost of more than $400 billion in 2023.
After being inspired by a scientific paper published in Nature, I decided we could create a system based on personal memories to induce a boost of positive emotion in human subjects to help to treat disorders, making the brain create the natural good feeling chemicals to overcome depression symptoms.
C'était bien? Oui, super. Super! The first trial back in 2019 showed very promising results, but it wasn't scalable.
But with recent advances in artificial intelligence and machine learning, the process now called VRPME is scalable, completely scalable, while also being personalized to each patient, culture, and language.
It's these gestures of love that define who you are, and it's something I deeply respect.
That was incredible. Actually brought tears to my eyes. It was almost like euphoric. Well, it's like a kind of an injection of a drug, really. Like,
really?
Oof, this is intense.
Yeah, that was really, that was amazing. Honestly, like that was really, it was just so much more powerful than ever imagining something like that. Like it was just there, and I didn't think it was going to be that powerful, to be honest.
This is Jimmy. He's just come back from the 2024 Paris Olympics. He'd put in years of training, but didn't achieve the expected outcome. We felt he'd be a good candidate to see if VRPME could help re-enthuse him to train for the next Olympics.
Like, to be honest, like the first time since the games where I've been excited to go back and start training again. Like, yeah, which was really like, it was like, wow.
Yeah, this is personalized emotion AI technology, and this technology has been developed by Dan and his team. And what they produced, mind blowing. It was beyond my expectations, and thank you, Dan, for that. We also validate our data with Flinders University, and in this trial, we show a significant difference between a generic experience versus our personalized solution. And the good thing on Wholesale Investor is that we also have, thanks to that, met InTruth that are measuring emotions. And thanks to that, we hope to go together, we can actually measuring instantly emotions and see how our technology can impact directly the patients.
I know. After everything that you've seen, you must be very excited to invest in Brain Vector. The icing on the cake is for us that we have a patent applied for our technology and our process.
And on the top of the icing, we have the cherry. And the cherry is that we have a unique technology that can be used in different markets. And we test it in aged care. We test it with patients with depression. We test it, we show on the video, with the Olympic athlete. We have a project with a patient with PTSD. We're discussing with corporate, how in corporate world we can improve mental health in corporate and reducing burnout. We also even discussing with space agencies, how we can keep our astronauts going far in Mars, keeping them mentally healthy. And we have discussion with the defense and veteran affairs. So you can ask yourself, how is it possible with one technology to reach all these markets? The answer is simple. It's because we are all human and we have one brain, hopefully. So let's dig a bit in the technology. So with this hardware that you put there, you can actually reactivate your positive memories. These positive memories are inducing a boost of positive emotions. These emotions that you feel actually release the neurotransmitters like serotonin, dopamine, and oxytocin, and can change the mood, your mood, and the mood of the patients. So it's a very precision technology, and that can be used for every human. So actually, the application is endless. And that's our cherry.
Oh, Steph, thanks. So, Steph, from the moment that we met, you told me we can do everything, but not at once. To have a visionary like Steph in the team is amazing. And together, we deliver. To get into all these different markets, we need to raise our next round of funding. And that's why we are here today. By Q4 2025, we need to deliver robust data set in our first market entry, which will be a companion tool for psychologists. In the meanwhile, we will do several different pilots, small pilots with 5 to 10 subjects in all these different markets in order to get data and explore market traction. Another very important ingredient to our cake is our amazing team. As you can see, we have a very passionate team with industry experts from different industries, such as legal, finance, marketing, IT, ops, and medical. And of course, we have our amazing office dog, Lila, who brings joy to the office. I have a background in AI and health tech innovation. And because of my superpower, I started my first company when I was 15 years old, thinking to do things out in a different way. And since then, I've been a serial entrepreneur with the last 10 years in the mental health tech space. Steph over here, our visionary, is, is renowned in neuroscience. And with his experience, combined with his experience as a pilot, he brought the scientific foundation and the innovation vision beyond brain vector and via PME.
In the last 6 months, we already deliver amazing achievement. We raised successfully $500,000, and with this $500,000, we delivered and we produced our first product. We submit a patent, and we made market validation. So we have a very important inflection point to reach by end of 2025, and with this inflection point, we need to generate very strong data, and also we need to reach another technical readiness level. And that's why we are here, and that's why we are raising 1.5.
So as we established, we have a very big opportunity with brain vector ahead of us. With the data and with the help of your investment, we can reach an incredible ARR, annual recurring revenue, of $250 million in 5 years.
Yes, so join us in this amazing journey. Together we can bring brain vector globally, and especially we can change life of people living with mental health issue and also enhance mental performance. So join us in this amazing journey.
So I would invite all of you to take out your phones and scan our QR code. We started our expression of interest for our seed round last week, and we've got very high traction already. So please join us in the future of personalized mental health. Thank you.
Thank you.
Good afternoon, everybody. Welcome to the afternoon session. Hope you're all still awake after lunch. So I've got some exciting news to share today, and it's the passion of sports fans. Australia, as you know, punches above our weight here, particularly in the recent Paris Olympics, let alone football and the rest of it. But we started this company pre-COVID in Sydney. We're Australians, and now we've set up a company in the US. Today I'm going to take you through a new journey of what the fan experience looks like for the younger generation. But first of all, I just wanted to take you back to what's currently going on in the economic climate and sports technology. This is classified as sports tech. We're in the fan engagement, so we create immersive experiences using augmented reality and virtual reality technologies to engage the younger fan. Think of it as a second screen broadcast to the main event on 2D broadcast, where the fans can interact, predict what's going to happen, and they are rewarded as well. Along the way here, this year alone, there will be nearly $20 billion invested in technology and sports. One stunning new piece of fact that came out this week is that there's 9 new unicorns in sports technology this year alone. And in fact, over the last 10 years, there's been 35 unicorns in this space. That's phenomenal. And in the next 10 years, there's going to be over $120 billion invested in what we're talking about here. As I said, it's immersive. It can be delivered on any digital device. We actually distribute through mobile phones, through the camera of your phone, and it projects a digital format of the real-time game itself. Let me walk you through a couple of the products. The first is the 360 fan-controlled opportunity to stream that you've never seen before. We've done projects in horse racing, car racing, where we've positioned the 360 cameras on the jockeys' helmets, and you can, on a web interface on your cell phone, jump from horse to horse, rotate the cameras, and place a bet. And we actually distribute this through broadcasters and brands and sportsbooks. The second product is the augmented reality AR tabletop experience. And we've got some major announcements today with some US sports that I'm about to share. But that enables a younger fan to watch a live animation version of the game. And we have lots of different IP rights that we're buying up around the world. So we're going to talk about that in a minute. The third product is more of virtual worlds and metaverse, where we're creating digital worlds for entertainment. So what do we have here? On the contract plate, we have signed a 5-year contract with one of South America's largest broadcasters in Mexico City called TV Azteca. The opening FIFA game in the next 18 months is going to be at the Azteca Stadium in Mexico City. One of the richest private families in Mexico. We've rolled out a Liga MX, is their national league, similar to the English Premier League, where we've positioned 360 cameras behind the nets in the corners, and the fans can control their experience, but be on the pitch. But they can't do that in 2D broadcast, and they can also engage and interact. Other contracts are with the NFL, and we've done our proof of concepts. We went through a period of time where we purchased the data rights, and we turned the data into animation. And partly this is due to AI as well. We have some more contracts that are currently illegal with the NBA, and we've got a new contract which we should be closing at the end of the month with La Liga, which is the biggest football leagues in the world, where Messi used to play for Real Madrid and Barcelona. So we're going into a new form of entertainment. As you can see also at the bottom, our validation is that we've won about 7 or 8 awards over the last few years. And this is one of our latest awards. It's for a music artist. Does anyone know Paul Oakenfold from London? Is anyone young or old enough over here? Good. So we turned him into an avatar using our technology and created 14 virtual worlds where fans could actually interact with these online worlds. And then we launched a movie with Apple TV 18 months ago. And in the last year, the Producers Guild of America awarded us with a major nomination for Best Immersive Experience. This is a video that I just want to do some highlights here. Goes through a few projects. This is a Telemundo Music Latin Billboard Awards, where you held your phone up to the TV at home and you collected digital icons, a bit like Pokemon. So you collected digital icons and got rewarded. This is our Super Bowl POC. So you'll see up and coming here the live simulation of the game in animation, and we control all the global advertising and sponsorship worldwide for this product. No one else in the world has got this. This is our horse racing project for the other crowd, where we put the 360 cameras on the jockey's helmet so you can maneuver the cameras and do live betting with the TAB. That's a separate product, as I said. And I'll just get you to turn the volume up to hear Paul here.
No boundaries. Electronic music and technology go hand in hand, and to be at the forefront of that technology and to be a part of all of us as a team, it's not just exciting for me, it's exciting, I think, for everyone who's involved, because we are going to see where it goes and it will evolve, and that's what dance music does. Electronic music has always evolved, so if you don't evolve with it, you will get left behind. Look, I don't fully understand it. I'm as curious as the next person, but it's a great first step.
That's the quality of the animation. It's photorealistic as well, and we're using all the latest technologies. This is some of the formatting and imagery from the Super Bowl project. So we create a digital twin. If everybody knows Snapchat, Snapchat puts a digital augmented reality filter across your face, which you can share with your friends. What we're doing is back to front. You actually project outwards through the camera of your phone, and you can engage and interact with that data and animation. This is the TV Azteca product. So it's a multi-camera. It has multiple 360 cameras and 2D camera interface, and it's all sponsored and advertising as well. We have different commentary as well, but that's what it looks like. That's the horse racing interface. I'm just going to flick through a few here. This is a project we're just presenting to the NRL, where it's a tabletop game, and we did a product in Vegas and some more music projects. To finish off here, we're doing a bridge round. We've already raised $2 million US. This is going towards the NBA project and more into the NFL projects and some other operational asks. If you're interested, there's David, Carlos and I. We're doing actually a live virtual reality demo over at the table. So you'll see David and Carlos there. Sam, our chairman, he's had 20 years of hospitality, venture capital and gambling experience in Vegas, where he's currently situated. That's about it. I hope to see you again, and thanks for your time.
Hi everyone, thank you for joining me today. We are diving deep into a groundbreaking medical technology that's set to revolutionize cardiac rhythm management. And I'm joined by Andrew Shute, the Senior Vice President of EBR Systems, a company that's quite literally transforming how we approach heart failure treatment. Andrew, thanks for joining me today.
Many thanks for the invite, Rhythm.
Absolutely, it's a pleasure. Now, to set the stage for our viewers, EBR Systems has developed the VICE-CRT system, a remarkable device about the size of a grain of rice that's poised to revolutionize how we approach cardiac resynchronization therapy. So let's dive right in. Now, the technology, Andrew, is at the heart of your innovation, which is quite literal. Let's start the interview by discussing how does the VICE-CRT system's leadless, ultra-compact design provide a significant technological advantage over current cardiac resynchronization therapies?
Yeah, well, thanks. So all pacing devices, whether they are maybe pacemakers to treat slow heart rate, implantable defibrillators to shock or cardiovert patients, or cardiac resynchronization or CRT devices, they've traditionally relied upon leads or wires to deliver the electrical stimulus to the heart muscle. Now, these leads enter via a vein under the collarbone and travel to the heart. And they've long been the Achilles heel of pacing systems. And the leads, once they're implanted, they can migrate, resulting in a loss of pacing. The wire inside the lead can fracture due to repetitive motion. And specifically for cardiac resynchronization or CRT devices, the lead must be placed in a vein on the outside of the heart to avoid development of blood clots, which can result in stroke. So to address these limitations, the CRM market or cardiac rhythm management market has been moving towards leadless pacemakers and leadless ICDs. However, our YCRT system is the only leadless technology that could be placed inside the left ventricle to treat heart failure. And that's because these other leadless devices are around 20 times larger than ours. So if they were implanted into the left ventricle, they'd likely be thrombogenic, causing clots, which could then in turn cause a stroke. But in contrast, our device becomes completely endothelialized, or rather the heart's own tissue grows over and completely encapsulates it in about 30 to 45 days, removing any risk of clot formation. But importantly, as we are a CRT device to treat heart failure, we are not directly competing with these other leadless pacemakers, which are just used for bradycardia or treating a slow heart rate. In fact, we're complementary. Around 30% of all pacemaker patients go on to develop something called pacing-induced heart failure within about 4 years. And these patients then require what's called an upgrade to CRT, and our WISE device provides the only means to upgrade these other leadless pacemakers to CRT.
I understand. That's truly very fascinating, Andrew, and it's clear that such innovation doesn't emerge in a vacuum. Now, you have identified a substantial market opportunity that must be driving this technological breakthrough. So your company has identified $3.6 billion market opportunity. So can you walk us through this market potential?
Yeah, that's great. And that 3.6 billion is just in the US market. I'd just like to clarify. And this is actually made up of 4 segments. And the first 2 are for treating patients that are considered previously untreated, meaning they failed conventional lead-based CRT. And these are acute lead failures. So these are where during the implant, they were unable to implant the lead that paces the left ventricle. Then we've got chronic lead failures. So these patients had a successful implant, but however, the pacing lead subsequently either fractured, migrated, or needed to be programmed off. The next group is called high-risk upgrades. So these are these pacemaker patients I referred to who develop pacing-induced heart failure that require an upgrade to CRT. Now, there's a large subset of these that due to their risk of infection or vascular occlusion, or they have other comorbidities such as diabetes or renal failure, the WISE upgrade can be used to avoid vascular and pocket-related complications in those patients. And the 4th patient we just touched on is leadless upgrades. And this segment is growing rapidly and really driven by the high growth rate and adoption of leadless pacemakers. And as we just mentioned, leadless pacemakers are complementary to us as we provide the only solution to upgrade those 30% of patients who develop pacing-induced heart failure to CRT.
Now, Andrew, what's particularly compelling about medical innovations is their ability to genuinely improve patient outcomes. So could you elaborate on how the WISE system's ability to reduce left ventricular and systolic volume in heart failure patients represents a breakthrough in treatment?
Yeah, thanks. Well, firstly, left ventricular and systolic volume, I guess you consider that a measure of the heart's efficiency. So it's a measure of how much blood is left in the heart at the end of the contraction phase. So the less blood there is, the more efficient the heart is, and resulting in a greater cardiac output. And studies have shown that a 10% reduction can result in improvements in both longevity and quality of life for a patient. Now, results from our CRT study were presented at the Heart Rhythm Society meeting last year and then published in JAMA Cardiology in July this year. And the headline result was an amazing 16.4% reduction in left ventricular and systolic volume. So to give some context to this, our study only enrolled patients who had previously failed lead-based CRT, or they were deemed too high risk for lead-based CRT. So it's a fairly tough group of patients to treat. And so we clearly exceeded that benchmark set by other studies of 10% by having a 16.4% reduction.
Mm-hmm. Your clinical results definitely sound promising, and it sounds like that you're ready to bring this to the market. Now, for my next question, what are the key strategic considerations in your US expansion plan? And specifically, how does EBR Systems plan to capture the market share, particularly within those top 252 hospitals?
Yeah, thanks. Well, the interesting thing about the US, it's a really highly concentrated market of high volume accounts. So there's around 1,900 hospitals in the US that implant CRT devices, but 50% of the entire market's in that top 252 accounts that you referenced. So our first year of commercialization will really be considered a limited market release. So in phase 1, we'll plan to target those sites that participated in our SOLVE study. And here we can leverage our existing relationships with these study sites to streamline patient identification and the implant procedure. So our initial focus here will be on building a sustainable utilization rate. So we're going to be initially targeting 2 implants per site per month. And once we start to achieve that, we'll then move on to phase 2 of our limited market release. And here we'll target high volume sites where we already have strong engagement from implanters. And then finally, we move into the full commercialization phase, targeting those additional 200 sites that make up that top 50% of the entire US market. So to support this, we intend to use a direct sales force. So we've already identified high-performing sales reps, and these are primarily existing contacts of either Eric Strandberg, our Chief Commercial Officer, or Mike Manassi, our US Sales Director. And these are reps they've worked with previously, and these tend to be individuals that specialize in introducing new technology into the market. And the right sales rep is really crucial to drive utilization. So during an implant, they can be 2 hours shoulder to shoulder with an implanter. It's a great chance for them to build rapport, maybe discuss a challenging implant they've recently had. After the procedure, they can look at the implant book and identify patients that may have had a failed CRT lead implant. They can call in on the cath lab manager, maybe look at the case list for the next few weeks to identify some other high-risk cases that could be converted to wires. And then on their way out of the clinic, they can go down to the pacemaker clinic, and I help to identify those patients that recently had their left ventricular, their CRT lead programmed off. And all this is to help drive, internal referrals.
Mm-hmm. Amazing. Now, Andrew, innovation doesn't stop with one breakthrough, as we understand. And I'm really intrigued by your development of a new rechargeable battery for the CRT system. Can you tell us how might this innovation expand your market potential and treatment capabilities?
Yeah, well, rechargeable battery is a really exciting product development area for us. And we'll be the first cardiac rhythm management company to introduce a rechargeable battery. And they're quite common today in things like neurostimulation for chronic pain. And our move has really been driven by feedback from our implanters and patients. It'll use induction charging similar to how you charge your mobile phone. And this will really help to remove barriers to widespread adoption. It'll have a 66% reduction in size, so it's going to improve the comfort for a patient, and reduces the need for future battery replacements. So in lieu of a replacement procedure every 4 to 4.5 years, the patient will simply recharge their device for 1 to 2 hours every week or two.
Wow, amazing. That's a wonderful step moving forward. Now, Andrew, as we look ahead, 2024 has been a significant year for EBR Systems. So can you walk us through the key milestones EBR has achieved in 2024 and what are your primary strategic goals for the coming year for 2025?
Yeah, so one of the key milestones that we hit in July was publication of the SOLVE results in JAMA Cardiology that I mentioned earlier. This has a really broad reach. It's a high impact factor journal, a lot of scientific credibility. Interestingly, we've received some feedback from the journal of the reach that it's actually had. There's an independent group called Altmetric that track research outputs across all scientific journals. And they notified us that our article was in the top 10% of all research outputs ever tracked. So this is measuring the quality and quantity of online attention that the articles had. So I think that bodes well for reach and awareness amongst the wider scientific community. The other big milestone was at the end of August, where we submitted our 5th and final module to the FDA as part of our PMA submission. The FDA notified us that they'd begun their substantial review within 30 days rather than the customary 45. And that bodes really well, I think, for the rest of the review cycle. And as we look ahead, we're expecting FDA approval early next year. Then following this, we'll begin execution of our commercialization plans. So reimbursement will be established, retraining of physicians on the implant procedure, and then we begin initial commercial cases in the US. Outside the US, we'll initiate 2 important clinical studies. The firstly is TLC, or totally leadless CRT, and this will really support our transition from treating previously failed patients to becoming first-line therapy, and this is by treating newly diagnosed heart failure patients. So this will involve implanting a leadless pacemaker alongside wires to deliver totally leadless CRT. The second study is called Access CRT, and this will build on our early work using the wire system to pace the heart's own conduction system leadlessly, and this will enhance the clinical utility or application of the wire system. And then finally, the other big milestone for next year will be expansion of our manufacturing facility, and this will allow us to increase our margins by continuing our transition away from contract manufacturers towards bringing in-house the full manufacture of our transmitter and electrode.
Amazing. Well, I would like to thank you, Andrew, for providing such comprehensive insights today. What you and your team at EBR are doing is indeed truly remarkable, not just developing a medical technology, but offering hope to patients with few other options. To our viewers and listeners at Wholesale Investor, this is more than just an investment opportunity. It's a chance to support a technology that could fundamentally change how we approach heart failure treatment. So please feel free to reach out to the team at EBR Systems. And Andrew, once again, thank you for joining me today in this conversation.
No, and thanks again for the opportunity, Rhythm. We always look forward to any chance we've got to share our story with the wider investment community. Thank you.
Wonderful. Thank you.
Good afternoon, all. I'll try and match Samir's energy and enthusiasm there. I'll probably fail. My name is Henry Okoye. I'm the General Manager and Director at LithTech Industries, and we're an early stage water and mineral processing technology company. Through some of the not so important disclaimers. And so why LithTech? Now in 2022, according to the United Nations, approximately 700 million people globally were living with no access to basic fresh water. Now, as we stand here today, that number is closer to 1 billion people globally. Now, as you can see from the graph or the map next to it, that number will increase to almost 2 billion people by the year 2050. And if what the World Economic Forum and the World Resource Institute say is to be believed, by 2050, approximately 30% of the global GDP will be affected by this acute water stress. That is $70 trillion of the world's GDP. What does this mean? This means that global desalination technologies will continue to evolve and the demand for them will only continue to rise. Currently today, the market for that stands at around $20 billion, and it is forecast to reach over $30 billion before the end of the decade. And as you can see, I was actually surprised to find out Australia is actually one of the countries that will be affected by that acute water stress by 2050. And so what LithTech has is a novel solution for high-growth industries, from water to critical and battery minerals like lithium, nickel, cobalt, and rare earth. Now the problem is, as I'm sure we all know here, there is this unending demand for those battery metals as we move towards the energy transition. Today, that market stands at over $300 billion, and it's expected to double to over $600 billion before the end of the decade. Now, the problem is there's limited resources, both freshwater, lithium, nickel, copper, cobalt, you name it, they're all in high demand, and no nation on its own can meet the requirements for the energy transition. And even those nations that are blessed with those resources simply cannot meet that demand on their own, especially with the current political instability around the world. Our LithTech solution is a patented processing technology that's able to be employed in both existing and new operations to increase the yield and availability of these highly in-demand resources. And so LithTech, as I said, the technology is patented. It's been independently verified and validated by the University of Queensland's Dow Center. It is targeting high-growth industries, and so we believe that we are here to make a significant difference long-term. We have sustainability at our core. Our technology takes any aqueous or water streams, and we're able to not just liberate clean hydrogen as a product, we also give you green cement in magnesium hydroxide, which can be used to sequester carbon. The company is founder funded, so our founders have put their money where their mouth is. Today, they've invested over $500,000 to get us to the point where we're at. And we also have a very experienced board with a clear pathway to an exit via ASX listed. Unless, of course, we receive a takeover offer that we cannot refuse before that. We also have existing commercial interest, which we can discuss because it's still hush tonight, so we can discuss it during the night. Like I said, we have sustainability at our core, so our technology has multiple ESG advantages, from being able to help assist the prevalent problem of huge mining tailings. Today, I think as it stands today, there's about 217 trillion liters of mining tailings around the world globally. And sitting in those mining tailings are key minerals that we need for the energy transition, such as lithium, nickel, cobalt, copper, and rare earths. We also sequester carbon, as I said, because a byproduct of our process is magnesium hydroxide, which can be used as a green cement. We're able to produce cheap and clean water while leaving zero harmful substances in the environment. We also preserve resources. So as of today, the traditional methods, say, for example, of processing lithium, leaves about 40 to 50% of the lithium as a waste product. Now, the analysis that we've done and the testing we've done to date show that we can get that number up to about 90 to 95%. And so we're able to preserve resources. We have best-in-class partners. ANSTO, the Australian Nuclear Science and Technology Organization, are one of our research partners. I've mentioned the University of Queensland's Dow Center have endorsed our technology from both a technical and an economic standpoint. Our chief technologists, where we do all the work, is run by Agile Technology in Lismore in New South Wales. We have Forecast, who are a global leader with clients like Fortescue and Wesfarmers, and they do all our financial forecast modeling, making sure that we know where we're going into the future. We also have corporate advisory run by Keops Group, and so both general and specific corporate advisory is covered. And so we are well aware of where our technology is going into the future. So I'll just quickly skip over this not so interesting slide on technical. So what the technology itself is a process technology that selectively separates magnesium ions from aqueous water solutions. Now, why is this important? Magnesium is very ubiquitous. And so in the processing of both water and those critical minerals like lithium and nickel and cobalt, magnesium is always a contaminant. And so our technology is able to selectively take that magnesium out, and not just take it out, but we also give it to you as a useful byproduct. The process uses what is called an electrodialysis cell, comprising of 3 chambers, and in essence, it's a magic box where you put in your feed water stream into it, and we selectively take out the magnesium from the water, while also giving you clean hydrogen as a byproduct. Now, why this is important is because conventional processes in industry today use harmful chemical reagents that usually need to be trucked in over large distances, such as soda ash or limestone and stuff like that. And they're very toxic to the environment. And ESG, as we all know here, is at the forefront of any push towards the energy transition. Like I said, there's multiple use cases for our technology, whether in water and wastewater treatment and desalination, or in the production of green steel, as our process gives you hydrogen as a clean byproduct. There's more use cases that I couldn't touch on today given the limited time, but please know there's multiple use cases for the technology, from lithium to nickel to copper to cobalt, rare earth processing, and of course the big one is in desalination. Now, as I said earlier, the University of Queensland's Dow Chemical Center has independently validated and verified our technology. They conducted a techno-economic analysis and found that for a typical lithium brine process, our technology was able to preserve the lithium by over 95%. Now, in industry today, that number is around 50% in the best operating processes. We also recover 90% of the magnesium as magnesium hydroxide, which is a green cement. And if what they say is to be believed, for a typical 35 kilotons an annum lithium carbonate plant, our technology can generate a net present value of about 300 million USD with an internal rate of return of about 20%. Now, those aren't my words, but their conclusion was that our process demonstrates a compelling case for continued development. So this is some of the independent testing we've done recently. We showed that we're able to liberate the magnesium hydroxide without any lithium precipitation. We showed that the process was able to operate continuously for over 40 hours with 98% Faradaic efficiency for the hydrogen gas capture. So very, very clean hydrogen. Next round of testing, which we aim to do with some of your help here today, we'll be looking to optimize the process for efficiency in terms of the amount of hydrogen we're able to collect, as well as the amount of magnesium hydroxide we're able to liberate. Now, LithTech is founded on expertise. Our chairman, who is here today, has advised multiple ASX-listed companies. He was involved in Citadel Mining. I don't know how many of you here know about them, but I believe they were, at the time of their takeover, they were $1 billion company from a $7 million company. David Vincent, who is also a chemical engineer like me, has over 20 years in the industry and is actually a pioneer in the biochemicals industry space here in Australia. I think he was involved in the launching and operating of the very first biochemical plant in the Asia Pacific. Adam Blunt, who is our chief technical.
Hi, good morning, everybody. Ravi here from Rolo Robotics. Very happy to be here. I think just to introduce ourselves, we are reimagining kitchens, and let me tell you why. There is a global crisis in the food service industry as we see it. In the US, there are 1 million job openings. Wages are going up to $20 an hour. Rentals are increasing. I think there's something that people don't really understand, but individuals don't want to do this job anymore, right? So then the cost of retraining, etc. And sunk costs are incredibly high in this industry. So if you've picked a location for a restaurant, the likelihood of it surviving more than 3 years is only about 30%, and that's a total write-off on your investment. So in addition, rent and labor represents 50% of a P&L in this industry. And that's ultimately driving costs up for consumers and prices. And add to that inflation through the wars, through supply chains, climate chains, etc. So it's also important to note it's only getting worse. And what I mean by that is students or the younger generation, as I said, don't wish to do this job anymore. They can make more money on TikTok than working at a fryer on a Friday night. So, and we, second derivative, we went back into the training schools. We're seeing students are not signing up for this industry. So we decided to, my co-founder, Tushar, and I, who's standing over there, we came in from Singapore. We decided to reimagine kitchens where robots and humans essentially work together in harmony whilst powering sustainability and affordability. And I think that's very, very important. A little bit of background on myself. I come from the food industry, so I know this pain point very well. My background is as an engineer, chemical and industrial, but was in the finance industry with Credit Suisse, as well as Cadbury Schweppes in a supply chain and manufacturing role. I've built food businesses, up to 60, 70 million in enterprise value in the past. So, but like I said, I know the pain point. I know where the puck is going to be. My co-founder, Tushar, has deployed robots around the world, 3,000 plus to be exact, over 35 countries over 4 years. Essentially autonomous cleaning robots. So again, interesting use cases of where many things can go wrong. For us, sorry, the font's not so clear here, but we've optimized not for scale as a team, but essentially building a team that can really deliver. And what we mean by that is in design and manufacturing, regulatory and compliance, fleet management, of course, domain expertise across robotics as well as food, and IP strategy being a very important part as we scale. So 4 months after starting the company, we built the world's first autonomous fast food kiosk prototype. It was a hypothesis that we had, and we launched it, like I said, without an idea of what we were going to do, but we did it. And the response was phenomenal. We tested a hypothesis, put it out there, and consumers loved what we were building. And not only consumers, but the ecosystem within the food industry. And what I mean by that is the largest restaurant groups, the biggest kitchen equipment manufacturers, who could see how our software and hardware stack would disrupt and change the industry. So 4 months later, we said we've got to actually deliver a unit. And that's what we did. From idea to revenue in 11 months. And we filed 3 utility patents, 4 more in the process. And most importantly, we attained regulatory approval where robots can actually run fully autonomous restaurants. So I think, again, going back to the problem statement, what we're able to do is scale fast, where our solutions are essentially plug and play with one PowerPoint. No exhaust, no sunk costs up front. Health and safety certified. 48 square feet in size, so lower rental footprints. Order to dispatch, what I mean by that is e-commerce enabled, digitally friendly, integrated with Deliveroo, Uber Eats, Foodpanda. So you've now got a system that can operate 24/7 without human involvement from a cooking workflow perspective. What are consumers saying? I think is always interesting. So again, as we launched, we launched last week, so the verdict is still fully out, but the early signs have been very, very encouraging. So again, excitement around the technology, but most of all around food quality and the service, because food is not a customer acquisition business, it is a retention business. How do we get people to keep buying the product? What do the economics look like? I think that's important. The early signs that we're doing 120 meals a day, $6 AOV, that's 21,000 Singapore dollars in revenue, leading to a store EBITDA of 38%. The traditional restaurant, best in class, is 18 to 20%. So we're able to now accelerate, almost double that, with a payback in 6 months. Again, these are projections, so we all know it's worth a bottle of scotch more so than the paper it's written on. But I think it is important. We do believe that with the setup and infrastructure and the team and the ecosystem that we're building, we will be able to hit and deploy 1,000 units in the next 5 years. We're actually in Australia to sign a contract to go into the mining industry, which again is a great deployment opportunity for us in this space. which also leads on to where we feel that this system can be deployed. We see educational institutions in the Singapore market. There are 375 schools, 18 institutions of higher learning. Again, where throughput may not be the most important thing, but ultimately gives us points of deployment. Transport hubs, we're in talks with the world's largest duty-free retailer concessionaire in Europe. Again, express interest to put these systems at gates in high mobility areas. Institutional caterers, so that's your Sodexos, Compasses of the world. Petrol stations, we think, again, that's another opportunity where, underutilized space that can now be, provide extra revenue for asset owners. That applies to convenience retail and hospitals. Not on this slide, as we've also inked an NDA and now in the process of developing autonomous solutions to go into this kiosk for the world's largest restaurant company. Not bad for an 11-month-old startup. How do we manage at scale? I think this is, again, if we're to achieve those unit economics, deliver 1,000 robots, how do we do that? At its core is our tech stack associated with fleet management. We are able to track every single item in this box, right? What's happening, where things are going right, where things are going wrong. We're able to see temperature, the chillers, the freezers, so food safety, etc., is also built in. And of course, sales tracking and analytics, which I think has been around for a long time. We do believe in the ecosystem, I think, for us to be able to deliver at scale. So we've had strategic deployment with conversations and moving forward with the Heinemann Group, Zeo, the Far East organization, which is the largest real estate group in Singapore. From a kitchen equipment perspective, we're working with Panasonic and also Rationale. So where our software stack would be able to control this kitchen equipment. So again, that future where human culinary craft and robotics come together. From an F&B perspective, we've deployed first in Singapore with Foodstar Kitchens. From a manufacturing and financing perspective, again, very encouraging for a company as young as ours to be able to have garnered interest from SMBC, Japan's largest bank, to essentially provide asset-backed financing to our customers. So we can now reduce the friction of purchases of this equipment where it's a fully robotics as a service subscription model. In addition, on the food side, we're working with the world's largest chicken supplier, CP Foods. So again, great validation for an 11-month-old company. What's next? We've obviously solved for fried chicken and the fry workflow. That's a $35 billion market size. We are close to finishing the pizza workflow in the next couple of months, along with the pasta and the wok workflow. So this allows us to expand our culinary offering to more customers. I'll ask, the market landscape is not large, but there are a few players already in the game. Hyphen, which is in the US, with one pilot test, the last round valuation was $300 million. Miso Robotics, which is doing frying in restaurants, but not totally autonomous systems. These two are more like appliances. It's a $250 million company. Circus Group, with one pilot in Europe, is almost a 500 million euro company. Again, so investors see this as the future of the food industry. It's coming whether we like it or not. From our perspective, we are revenue generative. We're looking at 20 million Sing as our valuation going forward on a pre-money basis. Raising $3 million, I think at its core, really engineering and talent and deployment. IP filing is expensive as an exercise, so we realized we need to protect ourselves on that. And then, of course, the deployment of kiosks. But with that, we recognize we're here. We'd love to meet strategic partners from a deployment, education, healthcare perspective. Again, petrol stations, convenience stores. So let's reimagine kitchens together and look forward to meeting later today. Thank you very much.
Welcome to Erth Points, where we're going to show you how our brand new patented international blockchain payment and reward currency is going to change marketing and loyalty forever, because it's much more than a normal marketing and loyalty system. It's a full profit system for businesses where the businesses only pay when the customer pays them and the clicks are free. So what's the problem every venture capital asks? Well, in Australia, we send over $5 billion every year to Facebook, and we send over $7.2 billion a year to Google, all to attract customers within about a 1 mile radius of all the local businesses. That works out to $8.38 for every man, woman and child in Australia. If we extrapolate those figures to the UK, that's £38 billion per annum, all to attract customers within a mile. Think about that. That's £750 million per week out of local UK communities. That's a problem, because from that $38 billion, which is sending overseas, they pay almost no tax. Nothing goes to the environment. Nothing goes to the community. Nothing goes to humanitarian causes. It creates almost no jobs in the UK. There's nothing goes to customer loyalty, because they don't want customers to be loyal, because they make profits from shifting customers from one business to another and then back again, because you're not getting another 10 million customers in the UK very quickly. There's also nothing goes to what the customer cares about, so it's very difficult to shift a customer from one business to another unless it's all about discounting, which means that businesses are making less profits. How does it work? Well, in phase 1 of the Erth Points system, we get businesses to join for a very low upfront fee. Their customers then join for free, and according to KPMG, over 85% of a business's growth and therefore profits come from loyal customers, but yet most businesses can't even contact their customers to make them loyal. The Erth Points system enables businesses to send their customers special offers via push notifications in the apps free of charge. A restaurant could send out free entree or dessert of a Tuesday, getting its customers to come back and again and again. It goes direct to the customer's phone and watch. And the business only pays just 3% of the sale when the customer walks in and pays that business. Phase 2. We allow other businesses to send out your special offers, non-competitive businesses. So a hairdresser could send out, "Hope you enjoyed your haircut, it looked fantastic, get a free entree or dessert on me at Bob's restaurant, the tiramisu is fantastic." Goes straight to the customer's phone and watch, so they get the attention. The restaurant pays 3% when the customer pays them. The hairdresser doesn't cost them anything. The customer gets a benefit. Everybody's happy. Phase 3. We allow clubs, churches and charities who are always desperate for funding to send out the business's special offers straight to their supporters. Could be, kids had a great game of soccer on the weekend. Give them a free meal at Bob's restaurant. On me as the hairdresser. Straight to the customers, the phones, watches, the restaurant pays 3%, the eco shares in the revenue, the hairdresser looks great and customer gets a benefit. Everybody wins. Revenue sharing. 20% of the customer, 20% of the customer's nominated eco, 20% of the environment, 20% of the referral network, which could be a bank or a sales organisation, 20% to Erth Points Ltd, and we keep any unpaid fees. With 10 million customers, that means we would, from just £167 worth of spending each week, we would earn £5 per week per customer, which is £50 million per week, which means £10 million per week would go back to customers who spend it back in the UK economy. £10 million would go to their nominated ecos, their soccer clubs, their churches, their charities. £10 million per week back to the environment. £10 million per week going to sales organisations and referrals. £10 million per week to Erth Points Ltd, and basically all of that money is staying in the UK economy, doing good in the world, and creating jobs for the UK, benefiting the UK. The technology is operating now. You can walk into a business, use your credit card through either your phone or app or just the credit card. There's no extra steps for the cashier or the customer, and the customer will know, here I am paying with my watch, I will know that I've earned Erth Points before the cashier does. Here it is. This is how much I've earned in Erth Points from the business. I can see where I've spent all my money, where I've earned Erth Points. I can see where it's all going. The charities can see where it's all going. And the businesses can see that they got a lot from this soccer club. They didn't get in from that netball club. And they know where now to target their next lot of marketing through the other businesses and through the other organisations. Our milestones are we currently partner with Oracle Corporation to look after our servers and security and databases. Every business in the UK can be part of the system. That means every sale in the UK you can earn Erth Points on. That's both B2C and B2B customers. We not only reward customers, but we allow them to pay with Erth Points through either the gift card system for big businesses, which means no extra hardware or software, or through the Biz app for small businesses. We also solve ESG profitable because part of our fee goes to humanitarian, community, environmental causes, enabling the businesses to solve their ESG obligations profitably. We get big data on purchasing, not just on search, which we've got a search feature. And that means through AI, we can predict where customers are going to purchase next and what they're doing. We have an operational domestic digital currency in Australia. We are not a security under UK, US or EU law. We have a licensed digital currency exchange in Australia, which can operate in the UK. Are offering 25% of the UK company for £2.5 million, and we have an IPO as an exit strategy. Thank you for your time. If you've got any questions, please don't hesitate to ask.
But hi guys, thank you very much for coming this morning. My name is Matt Graham. I am the CEO and founder of InSquare. Today I'm going to talk about a square and how it has endless possibilities, not only in health and fitness, but also as an investment. So let's set the scene. What is InSquare? InSquare is a world first smart force deck which measures upward force and downward force for functional body weight movements, resistive strength movements, isometric movements and balance movements, all in a compact 1 square metre with only 4 centimetres high. We have a prototype out here which you can come and have a look at, and it's applicable to all ages and all abilities. Now, why is this important? Because there's a big problem. 80% of adolescents and 31% of adults don't meet the World Health Organization's daily activity standards. And this problem's only going to get worse. Think about it. When we were kids, we used to ride bikes. We used to come home when the street lights went on. Well, it doesn't happen anymore. Kids now are on their phones, and worse still, they don't even ride a bike now. They press a button, the bike rides it for them. So, and this is causing a big issue globally. We have 1.8 billion inactive adults, and with 80% children being active, this is going to be a lot bigger in the future. 2.5 billion people are overweight. Nearly 1 billion of those people are obese. And this causes, what I alluded to before in some of the conversations, is this causes a massive health issue with cardiovascular disease, which kills more than twice as many people as any other disease globally. So what we're going to aim to do is we're going to aim to make movement medicine through sustainable, enjoyable, and accountable exercise. And how are we going to do that? This is all about disruption. We're going to disrupt an industry that for 150 years has no advancement in commercial connected cardio technology. You think about it. When you go to a gym, you're going to do cardio exercise, you're going to do a single movement, and you're going to do that repetitively for a long time. You're going to get on a bike, you're going to pedal. You're going to get a treadmill, you're going to run. If you're going to get on a rowing machine, you're going to row. If you want to do more than one movement, you actually have to go to 3 or 4 different machines. The last innovation in this space for cardio technology was 15 years ago with the introduction of the ski erg, again, based on a single repetitive movement. So meet InSquare, guys. In 1 square metre, we can measure hundreds of exercises and literally thousands of routines. We can take you from slam balls into running, into bicep curls, into push-ups, into lunges, into mountain climbers, whatever it is, balance movements, strength movements, and cardio movements combined. So no more monotonous single movements. And the device itself has an interactive display, lights that indicate your heart rate zone and your tempo, and it can all be operated by your foot and attached to monitors and apps and so forth. So We're smarter. What we're measuring is we're not just measuring repetitions, calories, tempo. We're actually measuring how much effort you applied, how much force you applied to that exercise. Did you actually did you perform with a lot of strength and acceleration, or just did you do it half-heartedly? And this opens us up to a lot of markets, and we'll get amazing amount of data for body weight, movements, balance, isometrics, resistance, and it can all be delivered on a mobile app or through electronic media such as screens and computers. And when I said all ages, I mean it, whether it be an 8-year-old or an 80-year-old, whether you be on a Zimmer frame or a wheelchair, whether you be an everyday athlete or an extreme athlete, we can actually give you routines and exercises, and we can get performance data which is second to none. Because of that, we apply to all markets, and you can see those markets there. We're getting a lot of interest in the sports tech area because what we're doing is really opening some eyebrows. Because of that data, we're able to do tests. Imagine a world where instead of your children just doing maths tests and English tests, went to school and actually did a physical test. Why aren't we doing physical tests for children at school? Why aren't we giving them benchmarks and saying, okay, this is your grade, you need to improve on that grade? We're at the forefront of this type of technology. We can actually gamify this, put them together and have a big screen like this, and we can, 4 of us can compete running and then doing push-ups, then doing movements and compete in a gamified format together. Or we can have competitions remotely, whether it be with your friend on the other end of a screen, or whether it be competitions within an organisation like HR department accumulating effort against the finance department. There's just endless possibilities for this. Classes, this could be full of InSquares, and we could have a big screen and we could all be competing with our data coming up live on the screen. You're accountable for what you do. If the instructor says do 200 steps, you do 200 steps. You can't cheat it. Remote training, for these outliers who don't want to go to a gym, we can actually send them to them. We can take the gym to them. The data can be pushed back to a dashboard in the gym. We can get preemptive tests. Remember, we can measure your weight. We measure your weight. So if your 80-year-old mother or grandmother, she's on the InSquare and all of a sudden she's lost 2 kilos, her strength has dropped 20% and her movement's reduced, that's a data push. That's a preemptive data push to family, friends, and physicians to say there could be something wrong. And this is all capable. Now, it's a big market. It's the connected fitness equipment market is $47 billion. This is going to grow double in the next 5 to 10 years. And now is the timing because health is on people's mind. A McKinsey's report, they just interviewed 5,000 Chinese and US citizens, and 80% of them said wellness is their top priority. And why? Because it's a problem. So we can also address aged care markets, weight loss markets, schools, clubs, rehabilitation, defence. Our markets are endless. So we've got a lot of opportunity. And to go on that path, we've had some good traction. We have a 20-year patent. We've got 2 international patents pending. We have a signed distribution agreement, which is with one of the world's leading sports equipment distributors. They are here today. You'll hear from them. Matt is a really good guy, but this relationship is really important because it's not just distribution for us. He's also an investor in our product, and we share networks, we share systems, and most importantly, they make all our accessories for us. We're not in the business of making accessories. We're in the business of producing a fantastic platform which is going to impact the world. We rely on the experts to do the accessories and distribution for us. And that's Matt, who you'll hear from later on. We are well advanced with the industry growth program, where we're now applying for match funding. We're working with CSIRO, some really cool algorithms which will affect health, and you'll see some big announcements on health coming out this week from the Australian government. We've got B2B distribution relationships in France, letters of interest with international gym chains. We're making moves. We're pre-revenue, but I tell you, watch this space. I can stand here in front of you today and say in a year's time, it'll be a completely different story, maybe even months. So to do this, guys, I don't want to be the smartest guy in the room, right? I have to surround myself by people who are smart. Merrick Howes has come on as a cornerstone investor for us. He is not only our cornerstone investment, he also is our chairman. He was head of Anchorage Capital, which is a $23 billion US fund in Australia. He was head of Anchorage Capital in Australia. He started up Goldman Sachs in Australia, headed up the capital markets there. He started up Macquarie Bank Asia Pacific. But more importantly, he is a world record holder in rowing. And he sits on the board of Athletics Australia, sat on the board of Rowing Australia for 10 years. And these are the sort of people that we have guiding our ship. My other executive team member, Lee Finnier, he's an ASX-listed CEO. They're developing Australia's largest battery manufacturing company. And he has a doctorate in artificial intelligence. He's an investor and he sits on our executive board. I have Darren Carlin here with me today. He ran a $100 million commercial scale business, biggest in the Southern Hemisphere for 15 years. He's here. He has manufacturing experience. He has operational experience. I have Matt Ward, also an investor. He is arguably Australia's best technical patent lawyer. He headed up Shelton IP as an investor. He's written every patent with an invested interest. Alexandra Sloan, she headed up Meta Marketing for Asia Pacific. She's now marketing director at Optus. Kathy Gruzis, chief technology officer at WetaFX. They make billion-dollar blockbusters, Avatar, Iron Man. Roger Westman, CEO of World Gym, a world industry leader in sports and fitness. Nicholas, who does all our data. He does all the data for Reserve Bank, IBM, Microsoft. I've got the team to help us take us to where we need to go. I understand the importance of that. From a competitive aspect, green is good on this slide. Whether it means, we're all movements, we're cardio strength, we're all markets, we're all abilities, we're space efficient, no moving parts, we're under 2,000 US dollars, and we've got incredible amounts of data that we capture. So we are an evolution. And this is what's been said to me by one of the world's leading foremost experts in sports technology who's approached us and put us on a list of emerging companies to watch out for globally, one of 2 Australian companies on that list. Vault has been measuring force plates. They measure athlete performance in AIS, jump height, and very, very complex data analytics. Vitruvian, another Australian company, they're electromagnetic pulleys, which is resistant strength. Now, those 2 companies in Australia alone have raised over 20 million US dollars, and they're segmented markets. They don't have the same market potential that we have. Tonal, that's just a machine that you put on the wall and you pull. It's a strength machine only. They've raised $500 million. Now, we're not talking about Australia here, guys. It goes back to what Steve said before. We're thinking globally. Our markets are huge. Tonal is a $1 billion company, $500+ million raised so far. For Me is another strength-only product. They've raised $140 million US dollars, and they're operating only in the home fitness space. We're home fitness, we're commercial fitness, we're rehabilitation, we're aged care, we're weight loss, we're schools, we're defence. We are everything, and that's what's really important. This is why we're on the radar. So we're in our seed round. We've raised $1.1 million to date through all our rounds, but in this seed round so far, we've raised $650,000. We're asking for a minimum of $50,000 investment. It's an equity investment, and we're also an ESIC. So that if you don't understand what an ESIC is, it's an early stage innovation company. There are tax rebates and capital gains tax benefits to being an ESIC. We're going to spend money on on administration, research and development is a big part of our spend. And we're going to be, a lot of that's going to be our take to market in early next year when we'll be launching our MVP. And along that way, we'll have some R&D concessions come in. We're looking at doing a reward-based crowdfunding, not equity-based. We're not giving away equity, just early discounts on if you order sooner. And so there'll be money coming in along the way. Timeline is we've gone through the ideation phase. We've gone through the creation phase. What you'll see today is not the end product. It's the prototype, the MVP, which we'll be testing in markets. will be coming early next year. So we're very excited about that. There's some, as I said, we're doing some really cool things with CSIRO, which I can't tell you about unless we sign non-disclosure agreements. So, guys, as I said, I'm very excited to be here today. Please talk to me. There's a magnificent opportunity, and I say this with excitement. We can really make a difference in this world, and we can attack some massive markets. And I believe that we can be the first Australian sports technology startup unicorn. And that's been, not just me said that, but people are better than me that said that. But in the industry, experts have said that. So join the experience. Now's the time to get in. Thank you very much.
Hi, my name is Chris Ventura, and I'm the CEO of Harness Projects, a global education and talent company. We founded Harness Projects in 2018 to bridge the gap between education and employment. We believe in creating a world where individuals can showcase their unique abilities to employers, allowing companies to hire with confidence instead of gambling on unproven talent. So our mission is twofold. For our students, we solve the classic job experience conundrum. That is, you can't get the job without experience, and you can't get experience without the job. And on the employment side, we help hiring managers try before they hire, observing talent perform in real-world working environments before making that critically important hiring decision. It's no surprise that AI is on track to reshape our future. And perhaps nowhere is this more pronounced than the future of education and work. Many will need to pivot into new career paths, and for those earlier in their careers who have had less opportunity to develop their workplace behavioral skills, the education to employment gap will continue to widen. Our model helps to build resilience against the disruption of AI by addressing this gap. So we designed a real project learning framework that directly integrates company projects into the student learning experience, providing real-world experience and skill training all within a single course. Project experiences are where we build not just our technical skills, but our behavioral skills as well. Things like critical thinking, resilience, and communication, the skills that make someone great to be a part of your team. In this example on screen, we have our 6-month UX design program, where students complete 3 projects with companies like HSBC, IKEA, and The Big Issue. And each project targets a specific technical skill area, whereas the entire experience develops their workplace behavioral skills. Our network of industry mentors guide these students through their projects and provide assessments on their employability across 36 technical and behavioral skills. Just like in real life, real-world experiences are the most effective ways to develop and evaluate our human skills. And we do this through our employability scorecard, a tool that we developed and this to assess and highlight performance across 36 technical and behavioral skills. The benchmarks for these skills was developed from input with some of the world's leading hiring managers in their fields, including from companies like Amazon, Meta, Qantas, Atlassian, Canva, and more. And we have developed these relationships over the last 6.5 years. It provides us access to a high set of quality industry data from some of the largest employment teams in Australia and the United States. Data like this is a significant opportunity for us as we provide deeper insights on talent that can't be found through traditional recruitment processes. Now, I've crammed a lot into this slide, and because we've done a lot. Over the past 6.5 years, we've partnered with over 125 companies, including leading brands like IKEA, HSBC, Qantas, Westpac, and many more. We've completed nearly 200 projects and expanded our programs from Australia to the US market. Our customer feedback is exceptional, with over 4.7 stars on Trustpilot, which is market leading for education. We've delivered projects in design, cybersecurity, product management, and digital marketing, and we've only just begun. We've set some really strong foundations for scaling our model. The B2C side of our business has established a strong product market fit with 40% year-on-year revenue growth and 65% gross margin across 2 international markets. The next phase of completing our growth flywheel is the expansion of our Real Project Experience framework to enable companies to use the framework as a turnkey talent solution. Now, we've already started to see this happen organically through the projects that we've delivered. We've had our companies come to us and say, wow, that person was incredible. Can I hire them? So we know that there is a strong need in the market for this approach. Coupling this with further investment in our tech to scale our data collection and provide hiring managers a new level of insight into candidate performance. Now, how many of you have hired someone only to feel that they weren't the right choice a few months into the role? Hiring managers often make decisions based on limited interviews, leading to a risk of bad hires and a lengthy onboarding process before someone is actually productive. We've all had this experience, no doubt. Our model changes this with a try before you hire approach, ensuring new talent can be chosen based on a robust set of experiential data touchpoints, producing a highly vetted and productive team member from day one. We call this a talent as a service model, which leverages all of the learnings from our real project courses and provides companies this turnkey talent solution. Candidates work on projects within the company's own business context, and we collect data points all the way through the project journey to give those hiring managers high confidence in their recruitment choice. Did the candidate communicate well? How did they take on opportunities for leadership? Did they demonstrate resilience and adaptability in difficult moments? This approach also ensures smoother onboarding as candidates already understand the company's culture and processes. Now, to ensure our company partners have access to all the deep insights that we collect on participant performance during a project, we are investing in an employability data platform. This is a platform that can surface workplace behavioral skills to hiring managers to help them make some really informed hiring choices. And we're able to do this because of the robust project experience framework that we've developed over the past 7 years. All the way through a participant's projects, we collect data on how they show up in their projects, their presentation skills, how they collaborate and demonstrate resilience. All of these skills then validated by industry-leading hiring managers who mentor the participants through the process. Now, one of the largest demand areas that we are hearing from our mentors and partners is in cybersecurity. Earlier this year, we launched our cybersecurity real project experience framework, and we are now the only company in the world with a fully project-based cybersecurity course from day one all the way through to graduation. The addressable cyber talent market across the US and Australia is calculated at $5.6 billion, and this is just one of the skill areas that we're targeting. Our goal is to have coverage across all the major high-growth digital skill areas as the world's global workforce is forced to pivot into new roles due to AI's disruptive effects. Now, Harness Projects occupies a unique space between traditional boot camps, universities, and talent provision services. Unlike boot camps that focus solely on training, we integrate real-world projects into our curriculum, allowing participants to develop their skills in a practical, hands-on environment. And unlike internship platforms or placement providers, we offer real-time visibility into a candidate's performance all the way through. This makes Harness a really logical choice for companies who don't have the resources to build and manage their own internship program. In 2025, we're focused on 5 key strategic initiatives. Our Talent as a Service product aims to sign on 5 cybersecurity pilot programs, allowing companies to trial candidates before hiring. We're developing our B2B2C tech platform to integrate both our models, providing transparency into candidate skills for hiring managers and a pathway to employment for the career changes. We're also continuing our investment in our employability scorecard and conducting further mapping on the experiential data points in our model. We're collaborating with the Digital Health Cooperative Research Centre and the University of Sydney to co-design a data science real project framework, expanding our offerings into data science talent market. This last one is a really great example of some of the organic reach out that we're receiving from universities and governments alike about our unique model. And finally, we will be undergoing the accreditation process of each of our real project learning courses to open up fee help and government assistance for our students. Our team has a proven track record of tackling tough challenges. Over the past 6.5 years, we have built a world-first educational model and scaled this across Australia and the US. We've taken market share from highly funded VC-backed competitors, and we've done this as a bootstrapped company. We've raised a small family and friends round in 2022 as we brought on our board of advisors, and we're now well positioned to take a meaningful step to fuel the reach of our model. My co-founder, Mike O'Brien, has over 25 years of experience in education and academia. My background has been in digital product management as former head of digital at Laureate Universities, and I bring a commercial and product lens to the work that we do. We've been really fortunate to have guidance from some exceptional advisors, including the former MD of Seek Education, former MD of Spotify and Peloton Australia, and the former CTO of Laureate Universities Australia. Harness Projects are now seeking $2 million to fund our growth plans and realize our vision of bridging the gap between education and employment in an AI era. Key roles will include investments in technology, sales, business development, and product. We have fully modeled our existing unit model and target goals for the next 5 years as we hire our key talent and scale our model across the US and Australia and beyond. Our growth flywheel and dual revenue streams make this a really attractive opportunity for the right investor. So if you would like to get in touch, please get in touch with me on LinkedIn or Capital HQ to view our deal room, and I can take you through this in more detail. Look forward to chatting. Thanks a lot.
Good afternoon. Good morning still. Things move fast in our business. Thank you for having me here today. Just as a matter of interest, I'm very thankful for that because it was just 3 months ago that I had a quintuple bypass. I've got the scars to prove it. And that showed me very much how fragile life can be, particularly when it involves your heart. And we've developed a product that will fit into the emergency response for people with sudden cardiac arrest. I'm just going to show you a quick video that will give you a bit of an overview of our business.
Thousands of home defibrillators are being rolled out in Australian homes with hopes that one day every household will have one. They weigh less than half a kilogram. They're easy to use if anyone suddenly collapses.
David Whiting is getting back to doing what he loves after suffering from a sudden cardiac arrest.
Something I hadn't experienced before. At some point, I just collapsed.
Every year in Australia, around 25,000 people go into sudden cardiac arrest. 80% of those happen at home, but less than 3% survive.
Sudden cardiac arrest is sudden, instant, surprising. You need something immediate because after 10 minutes, it's virtually impossible to bring you back.
You can now purchase a miniature AED, a key life-saving device, to keep at home.
Having one in the home where the majority of sudden cardiac arrests occur goes a long way to narrowing that survival gap.
Survival for people like David, who was resuscitated by an off-duty lifeguard and an AED.
The number one factor that helped my survival and recovery was early intervention.
Designed with instructions for both adults and children, it costs around $360.
You need to make it affordable to get into the homes. If it's too expensive, it just won't be bought.
It's hoped that by having an AED just like this one in every single home in Australia, within 5 years, tens of thousands of lives could be saved.
It's going to be peace of mind that hopefully you never have to use it, but you have something at hand that is literally can save someone's life.
Nick Hose, 7 News.
Thanks. So the company has dedicated itself to saving 100,000 lives by 2030. That's a goal of the business. And just to give you some colour on how prevalent cardiac arrest is, it is larger. The impact is larger than the top 5 cancers combined. It's 16 times more fatal than traffic accidents. It's 300 times more fatal than house fires. And cell aid can be as ubiquitous as smoke alarms. For those who have already met us in the exhibition hall previously, we do ask people a question if they know where the AED is in this building. And minutes matter to helping somebody in a cardiac arrest. I can carry this anywhere. I take it overseas with me. It goes in my carry-on baggage in an aircraft. And I literally take it to dinner with me. My wife puts it in her purse. It would be very tragic if head of investor relations of a company like ours wasn't prepared in that situation. So we're always prepared. And one thing to show you the ease of use, we have a training device and application is as simple as snap, peel, stick. And then it will go through all of the audible prompts, coaching the bystander through delivering what we hope to be life-saving care before the emergency services arrive. Sadly, in this room, there's going to be 40 people in the next 12 months that are going to experience directly sudden cardiac arrest or have a loved one or member of their community suffer cardiac arrest. In the first minute of application of care, your survival is about 94%. But over the following 10 minutes, your chances of survival diminish. And we are currently in the developed world at a point where only less than 10% of people who suffer cardiac arrest are surviving. And one of the biggest barriers to that is the majority of these events occur in people's homes. Our founder experienced that himself when his partner had a cardiac arrest. After she survived, he went and looked at protecting his family with an AED. What he found was expensive technology. Portability was low. Sure, if it's in your house, that is great, but we don't spend a lot of our lives sitting at home. And it needed to be affordable, as he said in that video. Otherwise, people will take the risk and forget about it or minimise it because the cost of mediation is high. We all insure our cars, we all insure our homes. This insures your life. We are the world's first personal AED. There was no point in making it a little bit better. We had to strive for the best AED available in the world. And technology and regulatory is a significant hurdle for that innovation. But our device is 75 to 80% lighter than a traditional AED, 70 to 80% smaller in form factor, and we've reduced the cost and maintenance of devices significantly. Not only does it do its job as a device in an emergency situation, but we can manage that relationship with the customer through IoT connectivity cellular. It will report to us on a monthly basis. It will report to us the incidents and the information that's collected during those incidences, so we can continue to build a better outcome for patients going forward. We've currently sold over 22,000 devices since we've been delivering to customers over the last 2 years. We are the #1 selling AED in Australia. We are outselling traditional brands by about 8 times. So we have identified a market that didn't exist, and customers are now coming to us directly and through channel partners to purchase AEDs to protect their families and communities. We are selling across 7 countries at the moment, and the majority of our customers are taking up a membership, which creates an ongoing relationship with that customer and a very big support to our business model. The addressable market is huge. I don't like the big numbers because they make people's eyes roll in their heads. But for instance, in New South Wales, there's 230,000 nurses. They leave their office or they leave their hospital every day with a massive amount of skill and a massive amount of desire to help people in their communities. What they're lacking is a tool. First responder networks like Good Sam or Pulse Point in the US or Suave Life in France, people are dedicating their time to be on alert when these instances occur. Now they can have the tool in their go bag or on their fridge door, available for their own family, but also in the community sense. There's millions of police officers. Then there's schools, often government buildings, all the places that you see these devices. But building a network, there is a huge market for our product and to improve people's lives going forward. So the subscription model, we sell the device for $600 up front. We include the membership free for the first 12 months, so we can invite somebody into that ecosystem to learn the benefits that they get from having a cell aid in their family. We will replace the device if it's used. We replace it when it reaches the end of its life. So we've taken that management and maintenance worry away from customers. We have the remote monitoring. We collect all of the data during events. And one of the questions that we get a lot is, can it be copied? Obviously, certain countries around the world have reputations. Medical devices are very difficult to copy. And even if you do copy one, the provenance of a medical device is important to the end customer. Sure, you can go and buy a $1,000 Rolex that's a copy, and nobody will be the wiser. But if you're buying a medical device by somebody who hasn't gone through the regulatory processes and the technical processes to prove that the medical device is going to do what it says it does, it's going to break down. So we are Class 3 medical device. We interface with multiple regulators across the world. We have thousands and thousands of compliance documentation, and they're literally one regulator or notarized body is in our offices conducting surveillance audits all of the time. We've protected our business with patents, design registrations, trademarks across the globe. So we've patented the activation sequence. We've patented the therapy within the device, which is known as a waveform, so that electrical discharge. We've patented the way the device delivers that discharge through capacitors and through the battery technology. So we think we've got about a 5-year head start on the rest of the marketplace, and we already have a pipeline of additional product-specific AEDs, such as the medical market or a military market, so that we can continue to build our business and stay ahead of the competition. So we're in the market at the moment, raising 15 million Aussie in a pre-IPO convertible note issue. We've got commitments of over 9 million. It's currently open, so come and see us for more details, and we're happy to have a conversation more about our business. We want to build a foundation for global and US growth going forward, so that we can service our goal of saving 100,000 lives by 2030 on a global basis. Thank you very much for your time.
Good morning, everybody. Paul Millard's my name. I'm the co-founder and the CEO of Invertigro. I guess first question, and make sure everyone's awake this morning. Hands up or give me an indication of those that have heard of indoor vertical farming as a thing. Okay, keep your hands up if you've actually been to one and seen one in operation. Okay, there's a few of you. It's a new space. It's emerging rapidly. It's an exciting one. And I guess the question is why? Why is it exciting? Globally, we're facing a bunch of issues with urbanising populations approaching 9 billion. That's driving the need for us to generate 70% more food by 2050 to feed this population with changing diets. Soils are being depleted and degraded at an alarming rate. We've got water scarcity as a major concern, and our resources becoming increasingly depleted globally. Erratic weather and changing climate are increasing the actual instances of weather-driven disasters as well, and they impact our ability to produce food. And increasingly lengthy supply chains are driving consumption of more resources, but also food waste, packaging, and all impacting our ability to feed the planet. So we simply must find smarter ways to feed ourselves. Indoor vertical farming is part of the answer. It's not going to answer everything, but it must be part of our food system globally. Reliably growing crops year-round, independent of weather extremes, with a fraction of the land used. We use less than 5% of the water of traditional agriculture. And with access to renewable power, we can get very close to a zero carbon footprint growing this way. So what this enables us to do is to build farms everywhere at any scale, with greater food security, fewer food miles, and reducing waste and packaging. Ultimately, sustainably allowing us to grow what we need when and where we need it. The challenge, however, has been to date that indoor vertical farming is complex and it's capital intensive. It's also been high OPEX to operate the farms. And this has led to commercial challenges with viability for many of the farms across the planet that have pioneered in this space. What Invertigro is doing is solving these problems. We're emerging as a winner on the global stage by bringing solutions that drive and enable profitability in this space. 4 key uniques to our business that we really focus heavily on. Firstly is the affordability of the farm and its ability to produce food at an affordable, cost-effective level to be able to make money, which is key. Secondly is scalability. And what you'll see is the way we've designed our farm in a modular way, you can build and scale to suit the needs. You can build a small farm and scale from any size up to a mega farm, and I'll explain how that works. The third is around flexibility, crop flexibility, to grow anything that can grow indoors. And that's key to our design as well. And finally, smart, that it is plug and play out of the box. We don't have to, our customers don't have to worry about the 200,000 hours of engineering and R&D that we've done to build our product. They can plug it in and start growing. That reduces the OPEX cost for highly expensive labour to run these farms, and it means that ultimately we can help build profitable and commercially viable farms anywhere. Our technology, our solution involves the hardware, which you can come and talk to us about, which is the growing unit itself, the software to run it on a SaaS subscription model, services from design the farm, build it, to ongoing farming as a service if our customers wish, and supply of the inputs, the grow media, nutrients, seeds. So there's a number of annuity streams to our business, as well as the upfront capital for the farm itself. The products that we've built and patented are unique across the planet. We have a inverted cube, which is effectively a farm in a box, and that unit is our commercial workhorse. Can be scaled from one unit you've got there to any number in a facility. The second is our inverter wall, which some of you may have seen in store in Woolworths. This is in Park, Sydney. We were running a pilot with them for about 18 months. So in-store, in-restaurant, in aged care facility, in school, so we can have a farm literally anywhere at the point of consumption. Now, these two combine to give us the ability to build really unique, highly efficient supply chains with a hub farm growing the produce, and then the produce displayed, still growing for the consumer, the chef, the bartender, the school kids at the point of sale or point of consumption. Competitiveness, affordability is key to our business, and that's how we win. We've been benchmarked against the best on the planet, and we're in the magic quadrant, that top right corner there, which is demonstrating both capital and OPEX efficiency against literally the best companies on the planet. This is part of a tender that was conducted at NEOM in Saudi Arabia with an independent assessment here. So we're in a great position to win, and we are winning on the world stage. Now, scalability is key. I'll talk about that in a minute, but flexibility around how the product actually works. You can see we can easily configure different crops with just minor changes in the way that we actually set out the farm itself, from microgreens, baby leaf, a whole range of different crops. So by having it easily configurable, we've grown 400, 500 different crops to date, from leafy greens to berries, edible and ornamental flowers, medicinal crops, microgreens, even exotic mushrooms. We can grow fodder and an increasing range of seedlings, which is pretty exciting. We can grow crops that can actually go out into other farming applications as well. We don't have to do it end to end. And this opens up a very interesting and massive market for us. So pretty much anywhere along the food value chain, we can build a farm to suit the needs or where there are disruptions or problems. Now, what that means commercially at any scale, and the scalability piece, from micro, this is a farm up in Cairns for research purposes with 2 cubes, up to, like Lego, any scale. That's our other farm in Sydney here as our MVP. And you can see the way the cubes actually move as a pallet, but we can build a farm into pallet racking at any scale. Now, the big market is a blessing, but also a curse. Where do you start? So we've actually zeroed in on a sweet spot to begin with, which is key market segments, as well as key crop types and key geographies. We have a $50 billion market conservatively, global scale, and we intend to go after that full market in time. Traction globally. We've got our first customers operational in Australia, multiple farms around the country. We've entered the GCC and have our first farm operational in NEOM, the biggest giga project on the planet. We're the first indoor vertical farm to be awarded a contract there, and we're actually up and running. That will be our growth engine as a business, the Middle East, the Gulf. We've got our first farm operational in the UK as well, and we're growing our UK and European markets next, and then we'll follow that with the US and Canada. We've got certain pilot projects already virtually done with those in Canada, and we look to expand that market as well. So traction building. Revenues. We are first year of I guess real revenue. Last year, 1.3 million Australian dollars. This year, financial year FY25, we should do 5 million Aussie. Now that's 7 million of contracted revenue, and that will be an LTV of over 24 million over over the next 10 years, and the pipeline growing. So pretty exciting. Sorry, what's happened here? I've been asked to change password here. I'm not sure why that is. Excuse me. Okay, very proud of some awards that we've been winning both locally and globally. The trophy cabinet is filling up. Increasingly and interestingly, it's not just for innovation, but also for our ability to influence and impact supply chain resilience and sustainability. So the opportunity that I'd like to share with you today, and please come and see me to discuss. Come and join our exciting journey. We're an Australian company. We're going on an amazing journey. We're a fair way down the path, but we're really starting to come out of the blocks. We've built and commercialised an amazing product that will revolutionise indoor farming and supply chains globally. We've got substantial revenues, both banked and won, and a healthy and growing pipeline. We've successfully progressed through our angel, seed, and our Series A capital raise, and we're preparing for our Series B next year. What we're offering is a pre-Series B opportunity to invest with a safe note. It's a discounted safe. It will convert to ordinary shares upon the close of Series B or 2 years. There's a discount off our current valuation based on and commensurate with the size of the ticket. Minimum investment of 100K, and we're raising up to $4 million, of which we've secured 650 to date for this round. Please come and see me. We're out on the booth outside, and I'd love to chat with you guys and share the opportunity. Thank you. There's a QR code there too if you want to quickly take a photo of that. Thank you.
I was approached by the two directors and guiding lights of the company, Matt Dixon and George Gregan. And frankly, I was immediately intrigued. First of all, I was intrigued by them because they have a high energy and that's always attractive. But I've always been a lifelong person committed to fitness. I ran the North Face for 20 years, and you couldn't do the hiking, the skiing, the climbing if you weren't fit. Frankly, what I saw was a tremendous number of parallels between PTP and their desire. They want to move into apparel, Bahi. I knew I could give them some good contacts, good advice in that area. And I had some super contacts in the UK, Kim Windsor, who we worked with on a number of projects together. And she said she'd join in. And so I knew I could contribute a lot. And I knew I wanted to be part of it because of the parallels that I saw out there. The reality is I liked him enough that I ended up being a part owner and also being on the board and advising them. That being said, the parallels that I saw and that I see to this day are, the first one is the people. People always make the difference in a company. And what you need in a sport company, I believe, is where the owners actually use the product. They aren't shills for business, they use the product. Quintessentially, nobody could be more committed to fitness than George Gregan, and Matt is of the same way. And at the North Face, we use those people. We call them trendsetters. People call them athletes, but the idea is you make the right decisions regarding products and processes and whatever if you have the right people at the top of the company. The second thing was they want to develop an iconic brand. And that's what we always wanted to do at North Face. That's what I did. And I know how to do that. I know how to add that value. So when I talked with Matt and George, they were intrigued about letting me contribute something. I also see that what is affecting the whole world are kind of two mega trends: globalization and democratization. Globalization being move everywhere. Well, that's a commitment they have, as we did at North Face. Wanted to be a global company. It doesn't happen overnight. It requires processes and procedures to be able to accomplish it. Democratization basically is putting things in the hands of the users. As opposed to having somebody just go to a gym, what they do is provide tools for people to work out wherever they are to be able to advance their health. That, to me, is the direction we're going to go there. The key of them wanting to build a great company, the best company, not just another company, not just a better company, but the best company, resonated with the way we always did it at North Face and what we wanted to do. The bottom line really is that it's great people, it's great products, and it's a desire to be the best. That's what I wanted to be involved with, and they gave me a chance to do that.
Thank you. I'm Matt Dixon. I'm the founder and CEO of Fitness Systems United. We've made up of 3 brands. PTP, which is our performance fitness brand. I'm just going to try and move that forward. which is our performance fitness brand, and Bahi, which is our yoga and Pilates brand, and then MediFit is a mass market approach to going via pharmacy, a similar branding to PTP, but targeted more at the active aging demographic. Just to jump into each one of those brands a little more, PTP, we're very much aligned with the strength and conditioning coaches and physiotherapists from some of the biggest sports, the most elite sports teams in the country, basketball, the Boomers, Rugby Australia, Netball Australia, Basketball Australia, Football Australia, so we do the Matildas and the Socceroos as well. So we get a hell of a lot of ideas and thoughts and feedback from those professional organisations, but we're making the products available to all. Key channels, obviously into sporting goods retail, but gymnasiums, personal trainers, and obviously direct-to-consumer. Direct-to-consumer now only delivers about 1% of our revenue, believe it or not, yet it's the most perfect product for that. Small, portable, durable, non-seasonal, easy to ship. So we're very excited about that opportunity. The company's been bankrolled today by George and I personally, and we're now really just looking, we're at a bit of a different stage to some of the other businesses you're looking at today, and we're really keen to supercharge and realise the opportunity we've got in front of us. The demographics are a little more male-oriented with PTP, and the primary consumer groups between 18 and 34. We know all this through our online sales. As we went around the world and grew the business, we started to see that multi-branded sporting goods retailers, but also multi-branded retailers, for example, Harrods, who we launched Bahi with only a month ago, really lacked a yoga and Pilates brand that delivered all the products like a Lululemon does. They don't have the option to sell that kind of product. So we were originally going to be Flow by PTP, and then we decided to call it Bahi, which is rooted in the origins of yoga from 5,000 years ago. Bahi means flow in Hindi. We've also developed through Kim Windsor the apparel range, and that was what got us into we're getting into John Lewis in the UK as well. So it's truly going global, and studios, sporting goods retail, department stores, and fashion boutiques are all primary suspects for us. And then MediFit is a much smaller range of products, all around strengthening, targeting the active aging demographic via pharmacies where there's a huge number of door counts. So we've just got into CVS pharmacies in the US. They've got 9,500 stores. We're in 260 of them right now. So the opportunity there, we've just pitched also to put some external pain management products in through PTP. And it's targeted at 55 and over demographic. George Gregan, my business partner, I think most of you would probably know who he is. He's former world record holder, rugby world champion. He's the athletic director for the business, extremely passionate about physical activity and movement for a better life. Hap, who's come on board, who you saw the video of, and Kim, who's got an OBE from the Queen for services to British fashion. We've got a great team, very high calibre, positioned in California, London, and Australia. This is what we've built over the last 10 years. The Lime countries are where we operate, and the list of the retailers that we're in are listed there, but we're in over 40 countries, and we've done that pretty much from Australia. Hence the reason we're here today, looking for a smart investor who loves and loves the brand, loves physical activity and wellness for a better life. So, we've got the other thing we've done is we've opened a number of doors. So Dick's Sporting Goods in the US, and I'll talk about why this is our growth model is both a mix of wholesale, direct-to-consumer e-commerce as well as brand growth. So for PTP, we've got a number of big accounts opening up. We've got Costco in Canada, which will then blend into the US. We're rolling out into CVS pharmacies. We've just onboarded with Dick's Sporting Goods and Dunham's. And then with Bahi, we've got a number of new accounts that are opening up as well as Boots in the UK for MediFit. So, we've done a lot of hard work opening all of these up, and where we see the three big growth opportunities is the first one is in replicating the success that we've had in a couple of accounts, one of those being Rebel Sports in Australia. We know that if we can grow 3 accounts, half the size of Rebel will be a $30 million business within a couple of years' time. We're currently a $13 million business. We've made money every year. Last year was a tough year for us, but every other time we've made money. We know how to make money in this business. What we just need is the right sort of growth capital to go and grow these brands and really realise the opportunity out there. The second one is to grow the brands, and that is through alignment with the professional sports, and we are looking to sign up ambassadors by sport. We've released our training app. We're going to have training specific programs through very high profile athletes in NFL, rugby, netball, basketball, etc. There'll be a bit of a revenue share play there, so there's not going to be a huge amount to pay up front. We've had a lot of conversations, and obviously George and Hap and people like that have really resonate with some of these people, particularly these athletes who are still athletes but thinking about what they're going to do after their careers as well. And that's how George came into the business with us. And then the other one is the digital platform. So there's a big play around that to increase our margins, but also as we bring these ambassadors and high-profile celebrities into the business, we'll naturally get a lot of cut through from a marketing perspective as well. So the Rebel model, we're in every store in Australia. We've got a 5-year locked-in deal with them. We're 2.5 years into that deal. It's got minimum purchase commitments. You can see we went from 7.7 to 8.4, and it'll be 9 million this year. And so as a $13 million business, that actually represents quite a high proportion of it. But 2 years ago, it was actually the other way around. It's just that the international business has slowed down, and while our customers sell through their inventory from the COVID explosion. But we are also in their strategic brands. So we're very proud to be put up there with the Nikes and the Adidases and invited into the tent. We actually co-develop products with the Rebel team, and we are able to sell those globally. So it's a very, very healthy relationship, and one that we think we can replicate very quickly with the right use of investment funds. So in terms of digital growth, so we've got our e-commerce platforms. We've got 7 sites up and running now, in 2 in the UK, Bahi and PTP. We've got PTP Canada, US, and we've got PTP, Bahi and MediFit in Australia. They're all integrated with our Oracle NetSuite platform. We've got all our subsidiaries set up. So we've actually got PTP Fitness Canada, Fitness Systems United Inc., USA Inc., and also in the UK Limited as well. So we've got a number of them. We launched our fitness training app this year, and it was just really a test to provide our customers, our consumers, because we don't know what they do with our products after they buy them, and neither do our retail partners. Now we know. We know how old they are, how often they're engaging with the app. We know what sort of intensity of workouts they like, what products they love. And this is all being shared back with the retailers, and we're the first brand that's actually doing it as a commission, recurring revenue commission for our retailers, which is really protecting our shelf space in the stores and deepening the engagement we're having with these retailers, because we can share that data. So we've had 18,000 accounts already set up without any marketing expenditure at all. So I think it's working. And the other thing is we can start to see now, because there are Japanese character sets coming in. So we've got Japanese people joining. We've got people in French character sets as well, French wording as well. So with the app that we've developed automatically converts into Japanese, French, or English at this stage. We're using AI to do it, and we're using AI voices as an overlay into those workouts. So we see obviously the other one will be through socials with these ambassadors that we line up with. So in terms of how we're going to grow, leverage existing global customer base. It takes 12 months to onboard with some of these customers, but once you onboard with them, you get a customer like Rebel. It's $9 million a year. It's for $60,000 per store per year. So we've done the hard work. We've got it to there. We now need to invest to really light that up. The software app, so recurring revenue and customer retention. We know more about those customers, as I just explained. We've got this growing database from around the world that we can take advantage of, as well as we'll be tapping into the organisations that we're already sponsors of, like the Swans and Carlton and Rugby Australia, etc. Okay, and then 3 subsidiaries in the UK. So massive markets. I don't need to explain them. The hundreds of billions of dollars in every one of the areas that we play. In terms of how we're looking for $5 million. It's for an investment. It's investment capital. We're not looking for debt. And pretty much 50% of that would be spent on sales and marketing over the first 2 years. And about 25% of that would be on operations and executive and finance. A bit of development in the tech part of the business, as well as the apparel, which we've already launched. And that's the growth trajectory that we're looking to achieve. This is all available, guys. You can come and talk to me anytime you're ready. And then they've just, at the back of that, there's a bunch of examples of us being ranged in different parts of the world. So sports experts in Quebec and Canada, that's Atmosphere in the Quebec. This is Tokyo, Zabio in Tokyo. So we've done the hard work. We're just looking to get a great partner in to help us drive this forward. So thanks very much, and look forward to speaking to you guys again.
Hello everybody. Sustainable Fashion Ventures is an early stage company currently completing a Series A capital raise. Over the course of today, I'm going to cover the three main challenges in the fashion industry: the opportunity, the numbers, the product, and the 2-year growth strategy. Every day, 50% of the global population wears denim. The mission of Sustainable Fashion Ventures is to commercialise the world's most sustainable and durable 100% cotton denims. The key problem in sustainability today is plastics. If you look at plastics as a whole, the number one challenge is consumer packaging. Think Coca-Cola, Pepsi, Master Foods. The second challenge, which no one's talking about, is the fashion industry. If you can see that slide there, you'll be looking at a pair of skinny leg jeans. Skinny leg jeans typically has 3 to 10% elastine in there, which when it's worn and torn and washed, abrades and releases microplastics, typically through wastewater and sewage into the oceans, which in turn leads into protein sources which are ingested by humans, leading to respiratory failure and cancer. The second major challenge in fashion today is scaling recycling efforts. To date, the venture in the United States of America has partnered with recycling providers such as Blue Jeans Goes Green and has successfully recycled thousands of kilos of denim. We are an early stage promoter of these services. The venture itself will continue to promote these services with partners in jurisdictions around the world to accelerate the use of recycling services, particularly for denim. Labour and modern slavery. So most cotton grown today, which is the primary component in a denim garment, is grown in emerging economies where they do not use machinery and advanced techniques to farm cotton. The venture itself will be working with the world's most advanced cotton farms. This not only ensures that the labour used in the farming processes is lawful, but it also means the complete reduction of insecticides and pesticides, which have been proven to destroy the biomass surrounding the farms. The opportunity. The opportunity is to use aggressive digital sales and marketing techniques to commercialise the world's most sustainable denims direct to consumer online, and to be number one in denim online today. The numbers. Denim's a compelling market to disrupt. Currently today, denim is about $85 billion in revenue direct to consumer. The market itself, as you can see there, is growing at a compound annual growth rate of 5%. That means today, in Australian terms, denim is 10.5 times larger than export beef, which is our largest agricultural export, and it's actually larger than iron ore, which is our largest export overall. Growth of denim sales online is estimated to continue at a compound annual growth rate of 12.5%. The reason for this is simple. The economics of direct-to-consumer businesses demand that they go online, particularly regarding the cost of staff and rent in the first world economies. The product. So the venture itself is the first in the world to develop 100% cotton alternatives for all major plastic use cases in the denim supply chain. We've successfully registered the green tab. This was an incredible and hard to describe result. It took over 2.5 years in court with Levi Strauss & Co. in America. Very thrilled to announce we've successfully registered those green tabs for the 3 major use cases being storm, tough and stretch. And we're the first globally online to commercialise recycling processes. The strategy. So the direct-to-consumer business is going to be executed through online marketplaces. These online marketplaces have already proven to rank top 5 in the United States, and we have successfully sold garments throughout Europe, the United States, and Asia Pacific. Localising content and centralising pricing and operations. So the strategy is to build a centralised team in a low-cost economy, bring in influencers from these denim purchasing jurisdictions, create the digital content, then redistribute out from the centralised location, getting the advantage of really low-cost, high-quality people and facilities in emerging economies. Continue to be the leading innovator in sustainable materials and processes. That's really building on our partnership with Cotton Incorporated, who is the world's top research and development organisation for cotton and thereon denim. Top 3 growth drivers, the transition to online. We hold top 5 SEO. The use of funds includes rolling this website out to the 16 top jurisdictions for denim sales. That will ensure not only the performance of our primary asset through the rolling out of these websites and the highly valuable backlinks, but will also ensure that we can continue that localization strategy in each jurisdiction, working with local influencers to promote the product. The dominance of denim, we lead innovation in denim. We were the first globally to remove plastics from the denim supply chain at a prototype level. Use of funds includes rolling those materials into commercialization. Emerging economies driving growth, China, Japan, Brazil, India. One key question that keeps getting asked is, can an Australian company compete? Well, we've got fantastic relationships with these countries within our region, and the establishment of the global headquarters in northern Vietnam gives us direct access from a logistics perspective to the 2 major markets here, with a deep sea port, access to Japan and Brazil. The 2-year plan, year 1. So it's a fairly simple plan. We're going to roll out these digital assets globally, establish a headquarters and corporate structures, begin scaling sales and marketing. To date, sales and marketing efforts have been done entirely digitally, and we have achieved $2.40 in revenue for $1.20 in sales and marketing expense. The headquarters location, we've sourced leases in the north of Vietnam, and we've settled on a location in a place called Hai Phong. The Vietnamese government, through their contract, has granted 5 years tax-free, 5 years under 4%. Hai Phong itself is a logistics hub, direct access to China, direct access to India, a deep sea port with international free trade agreements. The establishment of enterprise roles, when you're building a high growth, direct-to-consumer business, anybody who's got a background in AI and basically the automation of digital process, establishment of enterprise roles is critical to the successful growth beyond the $100 million mark. Year 2 really sees the development of a digital production studio. Think of a sort of a suite of little movie sets where we can bring in influencers, we can record marketing promotional materials, we can cut those into various file types, distribute them back out via TikTok, YouTube, whatever it might be. Increasing the sales and marketing cadence. Digital sales and marketing is a lot easier than traditional marketing in the sense that increasing expense is as simple as increasing expense if you've got the right assets behind you. High profile marketing partnerships. So breaking into some first world economies, obviously those economies have saturated messaging from a marketing point of view. Seeking to work with high profile people who understand the product and the impact of removing plastics from the denim supply chain will be critical to ensuring our success in those first world economies, which make up over 30% of denim sales globally. Invest. So Series A, 500,000 common shares at $10. Use of funds, as discussed, a 2-year plan to roll out global websites ranking top 5 all around the world in the primary denim purchasing jurisdictions. The development of a world-class digital production studio, execution of a direct-to-consumer sales and marketing plan, and then the ongoing commercialization of the world's most sustainable 100% cotton denims. Thank you.
Hi, my name's Panos Miltiadou from Prime Financial Group here in Melbourne. Today I want to talk to you about our Hawthorn residential development investment opportunity that we currently have in the preferred equity orientated capital stack. Before we get started, our disclaimer can be found in the information memorandum that you can download via the Wholesale Investor. This is not intended to be advice, and you should look at this when you get the opportunity via the IM. A bit about me. My name's Panos Miltiadou. I'm a partner in the property team. I've been working in the sector now for close to 15 years, and 10 years of that being with my own residential property development business. Delivered in excess of $270 million of completed projects, 77 million construction, 168 million in current pipeline projects, and Prime has invested through its client base $45 million over the course of that period in our projects. Over 155 million of supported senior bank lending to deliver our projects over the course of time. So the reason that I joined Prime is to assist in locating and finding the best opportunities and ensuring that our clients are protected through risk-adjusted returns. About Prime. So established in 1998, Prime has over 190 team members, multi-divisional firm, $1.2 billion of funds under management, offering accounting advice, self-managed super fund advice, capital and asset management advice, as well as preferred and alternative investing. We service mainly high net worth and family groups, as well as sophisticated investors. Preferred equity, what is it? So in the context of this project, preferred equity is an equity that comes in higher in the waterfall than the sponsor's equity, as well as the profit. So in a traditional development sense, senior debt is utilised to help settle land. Senior debt is also utilised to assist in construction funding. We take a preferred equity position, which has additional security, unregistered mortgages, personal guarantees, general security arrangements, and spring-in mechanisms to protect clients. So in the context of the waterfall, you'll have your profit, and in this case, over $7 million of profit. You'll have the sponsor's equity, which again, in this case, is $3 million, before you get to our clients' invested funds, as well as their return. So it's ensuring that we rank higher in the return profile to that of the developer and their profit. So the current opportunity I'd like to talk to you today about is 148 to 152 Riversdale Road in Hawthorn. It sits on the corner of Kooyonkoot Road in Hawthorn, arguably one of the better streets in Melbourne, ideally located, great resale values, and supported by amenity, parks, and connected shopping. The opportunity today is for a preferred equity position in which we are supporting an experienced fund manager and developer. That developer has sought finance from Australian Unity Debt Funder. The debt funder will assist in the construction costs over the course of a 20-month program. We have a 24-month term with this investment, thus allowing at least a four-month buffer. Aspire Construction Group have been appointed. They're a great builder with a good balance sheet, great capabilities, and the ability to obviously service the project through the course. We ensure that we do our due diligence on builders, considering it's been one of the most talked about components of the development cycle in recent times. The project is launching sales and construction at the same time. The idea behind that is to show future buyers and downsizers in particular that the site's progressing beyond that of off-the-plan sales. The project partners include an off-the-plan sales agent with great capability, has sold in the area previously, and has supported the gross revenue expectations of the project, as well as that of an independent valuer to support those values. Again, the term as mentioned is 24 months, and we're sponsor aligned. $3.3 million of equity and $7 million of forecasted profit. If we factor in contingency in the project and assume it has been spent, then at $9 million first loss protection to investors. Delivering 19 luxury apartments in one of the most prestigious areas, serviced with great internal amenity like swimming pools, hot spas, cold spa and sauna, as well as a mix of 2, 3, and 4 bedroom homes, all well appointed and all specifically designed for an owner-occupier downsizer, which has been the predominant markets in the local terms. The preferred equity position is 15% per annum to investors with a 24-month term. To date, we at Prime have raised $4.3 million, so 55% filled to this point. To give you a quick understanding of completed investments, we've completed a recent project and had investor returns distributed for a project in Elizabeth Bay, New South Wales. 21 high-end downsizer apartments, again, continuing the theme of downsizing as the predominant market across the eastern seaboard. $2.1 million of capital was raised for this investment. It was a 31-month term, and our investors took the benefit of a 15% per annum return. We've recently completed a project in Paran, 9 townhomes, $5.5 million was the raise, 31-month term, returning 10.5%. The rationale behind a lower return was that this was instigated during the days of less than 1% return in terms of interest rates. Gilby, New South Wales is an example of a current project. It's an industrial warehouse with a sponsor that's delivered 5 times prior in terms of this sort of stock as well as sales journey. It's an ordinary equity investment of $4 million. The term's 24 months. And again, based on the current nature of developing, 18 to 28% return is the expectation. Currently, this project sits $1 million ahead of its budget, hence the increase in return per annum, as well as 3 months ahead of project program. So how do you invest? The minimum investment is $50,000 for this opportunity. You have to be a wholesale investor. You can download the full information memorandum via Wholesale Investor, so online. In that document, it provides a lot more detail to that I've been able to provide in this short video. But things like sales and marketing strategy, location, comparable sales, builder capability, as well as fund manager understandings. We can be contacted in one of 3 of our offices in Victoria, New South Wales, and Queensland. But the best way to make contact is through wholesale@primefinancial.com.au. We'd be happy to talk to you and answer any questions you may have about the development and the investment. Thank you for watching.
Hello, my name's Sam, and together with my colleague Bruce, today we'd like to introduce you to the opportunity to invest in the ReadySet short-term rental fund. This is our disclaimer, and we encourage you to pause the video to read through. Let's start with the team. Who's responsible for managing this fund? So Bruce Davey, or Dr. Bruce Davey, is the Managing Director. Bruce has a PhD in mathematics from the University of Melbourne and has built up and sold 2 successful businesses, Optimal Decisions Group and Fastmail.fm, prior to founding and developing ReadySet in 2016 and the fund in 2019. Fund is the first in Australia to utilise the sharing economy business model to make efficient use of residential real estate through short-term rentals such as Airbnb, Booking.com and Stays. Bruce has also been developing HedgeMonkey, a privately held trading company, since 2020 and when COVID hit Melbourne. Myself, Sam Hawkins, the Business Development Manager, I have approximately 25 years personal investing experience, as well as experience in a family property portfolio, including developing, operating and selling a motel, various residential, industrial and commercial properties, as well as experience with residential colleges. And I've also previously owned and operated my own direct investment property for around 10 years. So I have experienced those visits to VCAT to recover rent, the unnecessarily and costly repairs, removing rubbish and post-vacating cleans, but I do know that it is a wonderful way to invest. We also have our operations and property team, who are currently managing approximately 50 properties throughout Victoria with a mandate to expand nationally. Over their 8 years of operations, they have managed over 50,000 guests who have booked over 200,000 booking nights. And our professional responsible entity is Primary Securities and Non-Correlated Group. So what led Bruce to starting ReadySet? And if we were in a presentation room today and we asked for a show of hands for those who have booked or hosted accommodation through Airbnb or another short-term rental platform, we know that there is a large number of respondents in that category, which is wonderful because it is a familiar business model to most people. Functions these days, whether it's family, friends or professional, everyone seems to want to talk about their investments and their property and the capital growth or the yield. They're trying to get ahead in life. Short-term rentals are indeed one way to maximise property yields. The takeaway from these functions is that the Great Australian Property Dream is indeed alive and well, and it's probably encouraged by our culture. TV shows such as The Block, magazines such as Better Homes and Gardens, shopping with Bunnings, hobbies such as DIY and podcasts, among many other things. Having stayed in Airbnbs personally all over the world, and having leased out an investment property and having rented a spare room on Airbnb, in my experience, short-term rentals do make sense. So the question, can I get a higher return from my investment property? At ReadySet, we say yes. Can I gain exposure to a wider variety of property? to diversify my portfolio? At ReadySet, we say yes. Can I reduce the the administrative and risk burden associated with direct property investment? At ReadySet, we say yes. ReadySet short-term rental fund aims to do these things. So what is it? The ReadySet short-term rental fund is an REIT focused on residential property operated as short-term rentals. It's an open-ended, unlisted wholesale unit trust. It's backed by equity in the property with a higher anticipated return from the short-term rentals. It targets quarterly distributions and redemptions to investors. And I'll now pass over to Bruce for more details on the fund.
Thank you, Sam. So Sam's covered the what. We're an investment fund focused on short-term rentals. Let me give you the 2-minute version of why you might get your exposure to residential property through a managed fund. The first reason is workload. There's actually a fair bit of work, even with a great property manager, in looking after an investment property. If you want to build a portfolio, it scales up. And if you want to do short-term rental, you've also got cleaners and furniture and guests to wrangle to add to that workload. Some investors try and skip some of this workload. For example, a common sin of direct property investors is to only look at 2 or 3 or 4 properties before making a purchase. Compare that to what a professional does. We might crunch the numbers on 50 to 100 properties to make offers on the ones we see as the best, so we can make the best purchasing decision we can. Probably the biggest reason is expertise. Short-term rental is very leveraged to expertise. Let me give you a comparison with long-term rentals. I'm sitting here in Melbourne CBD at the moment. If I was to find a 1-bedroom apartment 1 block to my north and another 1-bedroom apartment 1 block to my south, different buildings, different styling, different agents, different decisions made by those agents. But do you know what? On average, the rent received by the owners of those 2 1-bedroom apartments most of the time will be within 5% of each other. This situation is absolutely not the case for short-term rentals. The data I have on the screen here comes from a service we subscribe to called AirDNA. AirDNA track the performance of short-term rentals around the world. I keyed in when we were preparing for this presentation Melbourne CBD, and here's the first 8 of the 4,500 search results that came up. I was really struck by the difference between the 4 properties that it happened to have on the first row of search results and the next 4 properties it has on the second row of search results. The vast majority of them are 1-bedroom apartments, but the stark difference is that the revenue brought in by the properties on that second row is nearly double the revenue of those properties. Right? All bar 1 are 1-bedroom apartments, and in fact, the only 2-bedroom apartment in these search results is on the first row, the poor performing row. So all of those decisions about short-term rentals, where do you list it? How do you list it? How do you price it? Because, of course, we don't charge the same price every night for a short-term rental. How do we interact with the customers? All of those decisions have a big impact on the performance of a short-term rental. And so I'd not encourage people to go into short-term rental thinking, oh, anybody can do this. Investing through a fund helps you get access to a team that's been doing this for 7+ years and has a lot of experience and expertise in the space. Here's a quick summary of what we have to offer. A couple of things to specifically point out. Firstly, we have both a wholesale fund and a retail feeder fund, hence the fairly wide range of investment sizes that we can accommodate with our setup. We're a property fund, so this is something appropriate for investors for the medium to long term, not short term investment. Finally, we're an open-ended fund, so there is the facility for you to add to your investment over time. If you have any questions, please don't hesitate to reach out to us. We're more than happy to help you out. Thank you very much for your time.
Hi, my name's Evan Thornley. I'm the co-founder of Longview. We are a 10-year-old business with about 120 professionals. We do nothing but residential property. We think we know more about capital growth in residential property than anyone else in the country. We manage 4,000 rental properties for clients. Our buying advisory team have bought 1,000 properties each in the last 20 years. Our data science team has analysed every sale price of every property in Australia for 50 years. So what I wanted to do was share with you what we've learnt over those last 10 years as what I believe is the top ranked rental property manager in the country. So we know more about property investors and their properties and their challenges than anybody else. Here's the thing. Up until now, if you want to invest in the capital growth of Australian homes, the only way you can do that is by being a landlord. Now that is difficult, expensive, time-consuming and risky. Now there is a different opportunity which I'll share with you today, which we've created after seeing all of the challenges that landlords have. So now you can invest across residential property with diversification across a large number of assets rather than only owning one or two. And you can do that without the costs, taxes and hassles of being a landlord. You can invest across Sydney, Melbourne and Brisbane and get access to the capital growth in properties in all three of those markets. So the Longview Home Equity Fund, which I'll take you through today, is a way of investing across family homes in Sydney, Melbourne and Brisbane. Our target returns are a 14% internal rate of return over a 10-year period. And we believe we can deliver those returns without having any debt or in the fund at all. When I talk about residential property, a lot of people think that they're invested in residential property when really they're invested in something else. It's $11 trillion, the residential property market in Australia. Just 3% of that is new property development. And you can invest in funds in every layer of the capital stack there, in companies, in private credit, in a whole range of things. But that's really investing in a manufacturing business that makes new properties. You can invest in mortgage debt against those properties, the big banks, the hybrids and everything associated with that. That's 22% of the asset class. But again, you're not really investing in property. You're investing in the credit quality of people who live in those properties. The property is there as a security, but that's really any increase in value in the property has nothing to do with you as the investor. So to invest in the actual homes or in the capital growth that drives those homes, there are no investment grade funds right now, and yet that's the biggest portion of residential property. 3/4 of the whole asset class, $8 trillion, and yet the only way to invest in that for capital growth currently is by being a landlord. And believe me, it's the capital growth that you want to invest in. Every property market is a trade-off between capital growth and rental yield. And the Australian residential property market, particularly in Sydney, Melbourne and Brisbane, is close to the best capital growth market in the world, which also means it's one of the least attractive rental yield markets in the world. So if you're going to invest in residential property, you're going to want to do so with a focus on capital growth. But understand how huge that opportunity is. Just this last year, in just 1 year, the capital growth on Australian residential property was almost as large as the entire federal government budget. $624 billion in 1 year versus $680 billion for the entire federal government budget. That amount is 4 times the size of all the earnings of every company listed on the Australian Stock Exchange combined. So the biggest wealth engine in the country is capital growth on Australia's homes, and yet there's no easy way to invest in that other than being a landlord, and that is not an easy way. So if you were to invest in Australian residential property for capital growth, you'd have to choose the right homes. Now, what our analysis has shown is just 17% of homes, 1 in 6 homes, actually generate more than half of all the capital growth in Australia. We have a name for those homes. We call them Rodwells, robust, older dwellings on well-located land. Another way of saying we invest in dirt disguised as houses because land appreciates and buildings depreciate. So the properties that have got the best capital growth are the ones where there's solid older homes there, but the real value is in the land underneath them. These types of homes, these are homes in our fund right now across Sydney, Melbourne, and Brisbane. Actually, there's 55 homes already in our fund, ranging in value from just under $1 million to just over $6 million. So you can invest across a diversified portfolio of those homes and get a surprisingly strong return because of the unique way in which we invest. We're not buying these homes to rent them out. We're co-investing with the people that own them. So by giving equity to people who are either buying a home, becoming the bank of mum and dad for a new home buyer, or people who are in a home but want to get access to some of their home equity, we do a unique deal with those clients. We offer them equity. This is not a bank loan. There is no interest rate. There's no monthly repayments, but we'll offer them equity of, let's say, 10% of the value of the home. In the case of $1 million home here, that'd be $100,000. And they will give us in return that money back and 1/3 of their future capital growth. And so our investors only make $1 if the homeowner makes $2, so our interests are aligned, and we will only do this in homes that get really strong capital growth. And as a consequence, you get very strong returns without any bank debt at all, so none of the cost or risk of bank debt or interest rate exposure, and yet you're in a portfolio of high-quality assets. You have none of the costs and hassles of being a landlord. The homeowner looks after the home. They pay the maintenance, the insurance, the rates, everything as they always would. They tend to look after the home better because they're the homeowner. So by investing through shared equity offerings with existing homeowners in only high-quality homes, we can generate surprisingly strong returns with very little of the risk that you would have in investing in your own. Across a portfolio of 200 homes, which is our target for this fund, those homes will sell or the owners will buy back from the fund every year from year 3 onwards. And so it actually generates surprisingly strong cash flows. On our modelling, about 15% money on money returns from year 3 right through to the end of a 10-year period. The management team and the investment team are seasoned professionals, both in residential property and funds management. My co-founder, Anthony Cohen, and I, who've been building this business for 10 years, our chairman, James Hook, who ran a $6 billion infrastructure business for Macquarie, and Joe Scottney, a senior ANZ property banker, Ryan Levin, who built the property business at Wingate, large private credit fund. So it's a senior team that's overseeing these investments to make sure you're invested in the right homes. So this is the only way that you can invest across Australian homes in one place without the costs, taxes, and hassles of being a landlord, and get access to a target return of 14% on your money, despite the fact that there's no debt in the fund. So if you'd like to learn more, follow up with my colleague Matt Newham at Longview, and we can tell you more about the Homes Investment Fund.
Hello, thank you for your interest in FOIT. We are a MICE company, which stands for Meeting, Incentive, Conference and Exhibition. Allow me to introduce what FOIT is about. We are a Singapore company that was incorporated in February 2023. We started with almost nothing. Very little money, no office, no equipment, and don't have the needed manpower. By the end of December 2023, just 11 months after our incorporation, we were profitable with a revenue of $1.83 million USD. In order for us to grow the company exponentially within the next 5 years, we need to develop what we call MICE Plus services. So what is this MICE Plus services is about? It's about developing intellectual property services to capture a larger market. And that's the reason why we're here today. We are asking for 10 million equity or debt financing for the next 5 years. For the first 2 years, we will be concentrating on building and enhancing the core business revenue and begin our intellectual property development on the MICE Plus services. And year 2 to year 5, which is second phase, we will concentrate on the IP growth and fundraising. The second round of fundraise will be held in this phase 2. The reason is to provide additional financials to give the final push to our revenue and also to validate our valuations. And on the last phase, we will plan for IPO in about 5 years. Our revenue is contributed by 50% from events, 25% from logistics, 15% from conferences, and 10% from others, which include exhibitions, sports, permanent setup, design, and branding. The completed projects for FY 2023 was $1.85 million, and with the ongoing projects for the first half of FY 2024 of $1.48 million, we are having a total revenue of $3.33 million since the beginning of our incorporations until June 2024. And with immediate reachable projects that's coming up of about $1.15 million, we are expecting the revenue to be around $2 to $3 million. Our key customers is government and from different government agencies such as CDC, PA, LTA, MHA, HPB, and others. According to the market research, the worldwide value is estimated to be $904 billion as of 2023 and is expected to hit $1.9 trillion by 2032. And for Asia Pacific, the current value is about $184 billion and expected to hit $873 billion by 2034. And the China market is expected to hit $162 billion by 2030. There is a lot of value and liquidity in the market, a lot of projects available, but we need more enhanced mine services. With the traditional mine services, we will not be able to capitalize the market, and therefore we need to build our intellectual property shows and events where we have controls on when do we roll out all these shows and events. Some examples of what all these intellectual property shows and events are about is, for example, in IP exhibitions, you got this Avatar, the exhibitions that was held at the Gardens by the Bay in Singapore in 2022 to 2023. IP Carnival held by AIA Carnival Winter Wonderland in 2023 in Hong Kong. What we plan to do is to develop our own IP developments, such as Winter Wonderlands Singapore, sports and such as marathons and triathlon, IP future games such as League of Legends, building of theme parks, and these theme parks, at least in Rabbit Hole in Vietnam, is a theme park that we've been involved in when we're in our previous company. Another examples of building IP events is these developments of these generation mask exhibitions, which we will collaborate with Australian designer with endorsement from NASA to develop exhibitions based on mask. Our financial projection for year 1 is 21 million of revenue and 1.3 million of profit, and 68 million of revenue in year 5 with 6 million of profit. The reason why we are confident with this projection is because we have shown that we are able to be profitable in year 1 from incorporations. And not only that, the main reasons is because we will be using the bulk of the fund to make selective acquisitions on some of the target companies that we have already spoken with who are interested to come on board to allow us to take majority control. And these companies are with order books, and when we buy these companies, we are immediately able to take advantage of their revenues and profits. And therefore, the projections that we have shown here is highly achievable. This is how we intend to utilize the fund. 30% will go to M&A of selective assets, and 5% will go marketing, 15% will reorganize the company, 6% will be used on development of the IP, and 44% will be used as working capital to support the ongoing projects. My partner and myself have been in the industry for several years. I've been holding C-level positions for various businesses, and I'm also an associate lecturer at the Singapore University of Social Sciences, and I'm also a certified FOIT examiner, expert witness, and fellow at the Singapore Institute of Arbitrators with 22 years of experience. And my co-founder, Joel Fu, has also been in the business for many years. He has unique skills in Singapore and China in developing theme parks with 24 years of experience. The reason why you should invest in us is because we have proven track records. It is very rare that a startup company will generate revenues immediately upon incorporation, and we are profitable within year one. As you could see that the market is very conducive, high values around the world, providing excellent opportunity for the mines industry to grow exponentially. As mentioned earlier, in the M&A plan, where we target to buy selective company, these companies are with very specialized skill sets that would enable us to build our intellectual property events and sports and shows. And that would allow us to bring in tremendous value of projects. And that would beef up the valuations of the company through higher project values. And therefore, as far as capability is concerned, we are all ready to go. With the involvement of the intellectual property events and show, we will be able to bring in high margin projects, and therefore we will experience lucrative growth. We have experienced a team of employees together with us, the management team, and we'll continue to build the team with the necessary capabilities to develop the Mines Plus services to capture a larger market share. With that, thank you very much. Please feel free to contact me. Give me a call or WhatsApp or email. And please scan this QR code to get instant access to the deal room for more information. Thank you very much for your time.
All right, so now I'll get into my actual presentation. And the first thing I'll say is this really simply, is that I think this is one of the best times that I have seen for accessing for the foundations of growth, right? High growth and also high yield investments. And there's a number of things which come about this from a thesis perspective. And I started with a good portion of these at the start of the year, and then it sort of continued to evolve as it's sort of gone throughout. And so when I think about the direction which we're going to be taking things, for me, a lot of this started from a presentation that was hosted by Pep, right, at our event in May 2023, where he talked to me about the private capital marketplace area, or the private capital markets will grow from $13 trillion to $30 trillion from 2023 to 2033, so over a 10-year period. And that was interesting to me. And then I realized that I was thinking about my own business, not wrong, but there was a great adjustment to make to how we were thinking about our own business. But then when I started thinking about everything that was taking place in the markets, I realized that there was a whole bunch of business, technology, and macro trends all leading in the one direction. And the funniest part about it is I suddenly started to get super optimistic, even though in the last 2.5 years, it's been absolutely painful in the innovation space. Like, this is without doubt for companies that have been raising money, for people for advisors that have been involved in the space, for investors that have been involved in the space. When we have this conversation in private, most people agree that over the last 15 years, the last 2 years have been some of the most challenging years to be involved in the innovation space. So then all of a sudden, I'm getting super excited about the future, even though you literally could say it's been some of the hardest years in the last 15 years. So what are these actual trends? And the simple ones to highlight from my side, and I said, my brain is very simple, so I like to keep things simple for myself. And the way it sort of played out was these are the 3 key areas which I saw playing a role in markets over the next 10 years. And by the way, that's sort of typically my personality. I think to myself, okay, where is the direction of where things are headed? And by the way, what was beautiful about all of these is I looked at all of these opportunities and think there's a whole bunch of different players, but everything's fragmented. And to me, that's exactly how we came into this whole innovation space. When we came into the innovation space, there was only a few players, but no one was really taking an ecosystem approach. Everyone was focused on their individual activities that they were doing, right? So the key areas for me that I see as the great opportunity, the great succession is probably the biggest opportunity standing in front of us right now, right? For the next 10 years, you are going to see baby boomers looking to sell their businesses, succeed their businesses either to family members or to staff, or just potentially go through a private equity sale, etc. And the reality is about 40% of companies right now are actually owned by baby boomers. So this is, and it was one of my shareholders that outlined it to me, this is the greatest wealth transformation, right? The greatest wealth transfer that we will see in the handover of these businesses. You are talking about the unlocking of trillions of dollars of value in this actual succession space. So for me, you'll see, hence today, a lot of the conversation is around M&A, it's around going to exit. And for us as a company, when it comes November, we're actually going to be soft launching our business sales product as well. Because a lot of people have been utilizing what we do from a capital raising perspective, but the reality is what we've built is perfect for anything that's capital engagement related, whether it be capital raising, debt funding, or M&A opportunities as well. So the expansion of private market opportunities, I'll expand more on that shortly, but yeah, the expansion of that, when you think about all those different areas. Now, what's interesting, I'm doing an article on this at the moment, right, is that it's incredible to know how much how in the last like 10 to 20 years, the amount of companies that are delisting, as well as the lack of new companies that are listing, and especially if you took out, in Australia, if you took out all the resources companies that typically list, it looks even more bleak as far as how many companies are listing. Even though the ASX is one of the most efficient, listing platforms for accessing capital on the way in on an IPO, doing secondary raises, and also, providing, access for investors to participate, it's still been an incredibly tough market because regulation has become more stringent. There's more and more compliance onerous on the CEOs and executives, etc. So now less and less companies are actually looking to list. And in fact, I caught up with an investment banker last week, and they highlighted that they were speaking with a CEO of a $500 million company. And one of the things that they highlighted was that it's too early to be listed at 500 million. Right? They're thinking the ideal range is at $1 billion. And you sit there and think that's real. What made the ASX, to me, what makes the ASX great is the ability to access the small cap companies. So if it's getting harder and harder for CEOs of $500 million companies, imagine what it's like for CEOs of $50 million market cap companies. So that's why this area of private markets becomes super exciting. But of course, it's not as efficient as what the listed markets are. And then the last one is the rise of non-bank lending and also private credit. Now, I said it's absolutely become a buzzword, but the reality is the infrastructure has been set in place where it is a lot harder for the banks to do some of the lending that's been done. The reason this opportunity is, and this is what's so beautiful about markets in their efficiency and how they operate. When an opportunity becomes available, operators then create products, and then they create opportunities for people to participate in those products. And that's how this whole private credit space has become available, is because of where traditional banks have been left off from their actual lending. Now you've got the private operators and fund managers operating in this space. And there's lots of great new products and innovations that are coming out in this area. The next one is the innovation trends. Now, this is an area I'm obviously super passionate about. And so when you hear me talk about the first three, you think, well, does that mean we're not focused on innovation? That is absolutely incorrect. I think right now, and the funniest thing, it's still one of the hardest times to raise money. I think this has to be one of the best times I've ever seen from the investor side for participating in private companies. Number one, valuations are lower than what they were significantly a few years ago. Number two, what companies can do with a lot less money is absolutely phenomenal, right? And the key things I'll talk about, I know it's become hype from a buzzword perspective. The AI revolution is massive. There's no doubting how big it's going to be. When Sundar comes out, when Sundar Pichai comes out and talks about how it's the biggest technological shift in our lifetimes, absolutely believe it. Because not only have we seen what generative AI can do, right now we're seeing the rollout of AI agents. To me, that's just as transformational as what's happened in the last 2 years. I'll give you my own perspective. From us as a company, we did what every other company has gone through in this journey, right? We scaled up in 2020 and 2021. We scaled back in 2022 and 2023. The craziest part is we are now able to match what we were doing 2 years ago and actually go beyond it. And actually, we've increased out what we can do from a capacity and execution perspective with 1/3, nearly 1/4 of what the team members we had previously. That's the story that very few people are talking about, right? Because what you can do from a productivity perspective is absolutely amazing. In fact, there's 3 layers to the power of AI. Yeah, hang on. There we go. 3 layers to the power of AI, right? The first one is productivity. Everyone's experience. By the way, who uses AI on a daily basis? Okay, it's crazy. I'm hoping for the day that everyone's hands go up, because to me, it's like this absolute unfair advantage to have if you are, right? For me, I'll use like 4 to 5 different LLMs in a day just by normal course. Now, the reality is that there's the productivity layer. That's important. Then there's a second part to it that I don't think anyone's really talked about. The more you utilize AI, the more you save on your own cognitive capacity. For most founders, for most business builders, for most people in this space, we've got a million things being thrown at us every single day, right? We will have to make more decisions by 12 p.m. on a Monday than what most people have to make in their week, right? It is crazy how much cognitive capacity that saves us. The third part I discovered with my team last week. The third part that's really interesting is how much it saves team members' own cognitive capacity in dealing with each other. So I'll give you a perfect example of it. Who saw the article that we did on the US presidential elections polls? Who saw that? Surely someone did, because we had a lot of opens and a lot of interest from it. So the interesting thing about that article was that the graphic that was created for it was actually utilized with AI. Now, normally the process of doing that is that you'd have it would go to our head of brand. She would then work with a designer to go and create the graphic for that article. Now it's just a simple prompt and the graphic is done within seconds. So it's saving team members use of each other in the actual process as well. So, to me, that's where I think AI is so powerful in the team perspective. And as AI agents roll out, and I'm running out of time already, the convergence of technology platforms, I think, is a massive one. I won't spend too much time on that. Sorry. And the last one is the era of abundance. And so these are the trends that I'm focused on with AI. AI bots is a sort of starting point. That's been well done over the last sort of 18 months, but I'm still watching what it's doing because I can see more and more how now it's even been rolled out across the execution layer, right? The co-pilot to co-worker, this is exactly what Microsoft took the lead in. Salesforce are talking about it. And it combines with that sort of enterprise AI. The power of enterprise AI means that the need for companies to have the amount of layers of internal redundancy that they did before is just not required anymore, right? AI agents, last week was pretty much AI agents week, which is why we did an article about it on Saturday. right? Anthropic rolled out their computer use, which actually shows the computer working in real time, executing on different tasks across multiple software. If you can imagine what that looks like 2 years from now, and then imagine what each team member's productivity and their capacity inside a company becomes, you start to realize that the potential for the businesses coming forward that are utilizing this tech stack, utilizing these technologies, becomes exponential. And I'd say for every investor, the question I'd be asking to companies that you go into, I know most people want to go for financials, they want to go for, all sorts of areas. I'd be asking what's their tech stack they're using, because that will give you a perspective on where their head is thinking about the future. And then last one is Tesla. Tesla absolutely blew me away with what they did with their cyber taxi demonstration, right? They showed so much, and that's what, again, why we did an article about it, right? They literally showed everyone not only what the future of transport looks like, but also how the future product is where the consumer, the buyer of that product, can also turn what they're buying into a money-making opportunity as well. And it's creative how they're actually thinking about it, where they're thinking about someone buys a car, that excess capacity can now be a revenue opportunity for their owner. That becomes creative from a business model perspective. I love this comment because what it means is that future startups you're about to see, they will not need as much money as what they previously would. Every company I speak to at the moment, they're only looking typically to raise between 1 to 2 million, right? There's very few that are saying, oh, I'm looking to raise 5, 10 million, etc. But the reality is because everyone can do so much more with less, and that's exciting. So the impact that we'll see rolled out, firstly, the quiet redundancies will continue. This has just been ongoing. I said this at the start of the year, and it's been ongoing right throughout the year. It still happens today. That in 2023, it was popular to announce about making redundancies and saying that you're investing in AI. That's not as popular anymore. So they're just doing the redundancies, right? And they were even talking about that on the All In podcast, where they were saying basically companies are just not hiring like they were before. And the middle managers, supervisors, this is where you're seeing a lot of the redundancies go to. It's the middle managers, the supervisors, the cross-team coordinators, etc., because companies are looking to go for more activity, more direct action between leadership and obviously the workers in the company. And then the last one is the outsourced team members, right? Because if anyone's experienced, either investing into a business or owning a business over the last couple of years, going through redundancy processes, letting team members go, or just general workplace stuff is so a lot more people are actually investing in the outsourcing of team members going forward and then training them with AI, right? So not only getting, cheaper labor, but also incredibly productive labor when given the right training on how to use these tools. So, this is why I say a lot of companies can raise a lot less and do a lot more with that actual money. So for me, I think the explosion of startups you're seeing, but also the explosion of people doing more gig work economy as well, more gig economy work. The reduced need for large fundraising rounds. And the last one is, you're about to start seeing some of the most profitable companies very, very early on because they need a lot less money than what they did beforehand. So the venture capital trends, all these are still in play, still things that we're seeing on a day-to-day basis. This seems to be the core focus for a lot of the companies that we're coming out. And it's all in different ways, whether it be AI, robotics. And by the way, this leads to sort of our next big event that we're doing coming up. Right, but these are still the most common talking points in amongst the ecosystem about what they're focused on from an investment perspective. Obviously, I'm not going to spend too much time on this because I've done a lot of sessions on this, but obviously on the crypto side, whilst it has been going sideways for the last sort of 5 to 6 months, it is expected to go into its banana zone. There's still plenty of money going into the ecosystem, plenty of money being built. And funny enough, what's been really interesting for me is out of the US elections, the biggest winner by far has been crypto, right? Because both of them have agreed to basically look to make their framework and regulatory framework more supportive for Bitcoin and for the crypto ecosystem. So that, and then you combine that with global platform access, the fact that every single one of you can log into your ComSec account and get exposure to Bitcoin and Ethereum, that is powerful. Because if you've ever experienced the process of buying crypto, you know it's an absolute nightmare as far as accounts being shut down, getting calls from fraud areas in banks. If anyone really understood what the crypto ecosystem had to go through to get to where they are, where overnight they would have banks shutting down their accounts, cutting off their mortgage loans, doing all that sort of shit. That is common for every ecosystem, every business builder in the crypto space. So now, if that framework becomes more positive, watch the money flow. And then this is Kathy Wood's prediction that by 2030, she expects it to go to $3.8 million, which is phenomenal, right? Now, of course, for all the crypto holders, we hope that she's accurate on that. Who knows? It's a bet, it's a play long into the future, but it's done on the assumption that if the big institutional funds just start allocating a portion of their capital to crypto as it becomes more, and when I saw BlackRock do it, State Street do it, etc., mostly BlackRock was the main one. As soon as they saw them moving in that direction, you can see the sort of allocation of capital. Correct, Bitcoin, Ethereum, and also now the push for Solana as well. Correct, 3.8 million is her target for Bitcoin. Yeah. So these are some, I won't spend too much time on this given I've only got 10 seconds left, but these are some of the areas which have been popular for the actual crypto space. The funniest thing is for me, the real world asset tokenization, we've been seeing those opportunities since 2000. It just for some reason got rebranded this year and suddenly become popular under the acronym RWA. But we've been seeing those opportunities since 2020. The one I don't spend any time on communicating, but a lot of people have made a lot of money is out of the meme coin area. I don't understand it. It's not my area. But said I know it's done very well. But all those other, the one I think super interesting is the decentralized physical infrastructure networks. And I'm doing an article next week where I'll talk about Tesla's play on that. But that's also becoming becoming a high growth area of interest. On the private equity side, once again, you notice it's the common theme that I'm talking about today. These are the trends that we've been seeing in private equity. There is a lot more opportunities for high net worths and family offices to get into private equity products or private equity opportunities now. It's amazing how many investors basically acquire businesses as well. There's people that are coming out of college, instead of doing a startup routine, they're actually looking to acquire traditional businesses as part of it. And this is going to be reflected in what we're talking about today, as far as these are the trends that are coming out in the private equity space. So, it is very exciting. We did an incredible talk at one of our events on the forever acquisition model. That was from Chris Rolls at our Capital 2024 event. But you will see that the private equity area is going to have some significant growth over the next 5 to 7 years. And obviously, us as a company, we want to play an enabling role in that. And to give you a bit of insight we're planning that in July next year, we're going to host a business exit summit, and it will be completely focused around sort of private equity and the exit area. As I said, there just isn't that much content on this space, and that's why I can't wait for the rollout of today's session. This has been common for everyone. Yield absolutely still has everyone's focus. We've done a lot of events on this, but the reality is, this isn't going away anytime soon. And the reason is because Australia's interest rates are not coming down anytime soon. You can see this tussle between the government and the RBA, about what's happening in the markets. But the ultimate reality is, whilst interest rates come down 0.5% in the US, they're now 50-50 on if they're going to continue coming down or if they might need to just leave it or potentially increase them again. But in Australia, we all know that interest rates are not coming down anytime soon. So hence why, going where I started from today's conversation, between the combination of innovation for high growth, the rise of private equity and for growth opportunities, and then also you've got the access to yield through private credit opportunities. When have we ever seen the environment like this where it's so perfectly primed for yield, growth, and high growth? And so even though it's been a punishing last 2.5 years for the innovation space, that's why I'm most optimistic about what comes next. Now, the question is do I know the timing of this? No, right? But from a demographics and from a fundamentals that we're all seeing, because there's a lot of levers that can get pulled in this. And here's the levers. Interest rates, one of the biggest levers that can get pulled in the actual process. So these are the things that I'll be watching for my signals as far as what comes next. Will there be increase in money supply as far as, whether it be the central governments, buying and starting to stimulate and put money back into the economy, right? Will there be dry powder coming off the sidelines that there has been for the last 2.5 years, or that have been going into the private credit opportunities? And then the last one is, and we're less than 2 weeks away from it, is the US elections, right? It's undeniable that what happens in that election will have a significant influence in what comes next from a business perspective. So for me, these are the 4 levers that I'm watching to understand what moves I need to make. But fundamentally, the strategic direction around innovation, private credit, the non-bank lending area, what's happening in private capital markets, but then also what's happening in succession or business exit area. They are going to be the areas that we're focused on. So that is it for my presentation.